Good evening, sir.
Good evening, Kamesh.
Hi, Sumit. How are you?
Hi, Neil. I'm good. How are you?
I'm good, thank you.
I'm just going to on my camera.
No problem.
Okay. So I'm sure you must be in some work, Neil, in the last session, and that is why you didn't join.
Yeah, I
But
have guests at home and I had to go out that day. Yeah.
okay. And last session we done one of the very important topics, which as such is easy, and but if you haven't uh, heard me or listened to me, or like you haven't gone through the session, then this topic may be troublesome. Otherwise, this topic is easy once you go through the process of the session. So if you didn't get the time towards the week to go through this session of SWOT 1, please go through it whenever you
Yeah,
get time,
I will go through it. Yes.
right? SWOP 1, right?
Yes.
Okay, so Kamesh has joined, Yash Kenya has joined, Sujata has joined, Rahul is there, Hepzibah, Richa, and Dixit, Monica. Hepzibah, Richa, Dixit, and Monica are there, but we can't see them. So they are like playing hide and seek games with us. We will have to search them where they are. Same goes for Subbalakshmi, Nivedita, Rakshanda, Shubham, Ritvika, Satyaki, Ayushi, Mayam. So all of these people, we really have to search them where they're. Oh, so I just got Ramesh and
Sumit,
Subbalakshmi
I'm in office.
and
I'm in
Moni.
office.
Okay, Ramesh, yeah, great. Carry on. You guys can switch off. It's fine.
Sir, I'm
Uh,
also on work.
who is it? Who is it?
Ritvika.
Ritvika. Oh, okay. All right. I understand.
Hi
Sumit,
Sumit,
I'm
I'm this
also in
side.
office.
Yeah, Monica, I understand.
Hi Sumit, I'm also in office.
Who?
Mayank,
But I can't see your background, your office background. It's okay, man.
I cannot on the video.
Yeah, I know. I can understand that. Not all companies allows you to on your video, keep your video on. But I'm sure somehow that Ayushi and Satyaki and Shubham and Nivedita are not in the office. And Nivedita, I hope you are now out of your cold. Last week, Nehal Nivedita was having cold, and that is why she kept her video off. But today, okay, yeah. So there, Nivedita is fit and fine, right?
Yes, yes, Sumit.
Yeah. Have we started? Oh, still there is little bit of cold is still there.
Like
Little
I'm
bit of
suffering from dust allergy. Like if I clean or
yes.
something else, that happens.
Okay. So I yesterday only I was talking to one of my friends. He lives in London, and he was telling me. I was sharing with him that my daughter every morning when she wakes up, she's just 3 months old, and every morning she wakes up, we find that she is having this cold and her nose is all frozen. And so he told me there might be dust allergy to her. And for the or to deal with dust allergy, what my friend has done, because he has this, so he has bought some dust free or dust resistant bed sheet and pillow covers and all. He said that those are really helpful. I was really surprised to find that is there something like this. So please, for yourself, buy some dust resistant bedsheet and pillow covers, because bedsheet, and he was telling me that bedsheet and pillow covers can catch good amount of dust and
Mm-hmm.
hold good amount of dust. And because we sleep on it and we do not wash it every day, we wash it once in a week or once in a 10 days. So all those dust actually create a lot of problems. So if you have dust allergy, please buy some dust resistant bed sheet and pillow covers. Yeah.
Okay, Sumit. Thank you.
I hope you started exercise, because last time we checked with two people and both of them said we exercise regularly. I guess it was Rahul and one more. I forgot who was it. But Yash, I guess. And both had confirmed that they exercise and that is why they were fit.
Sasank Raj.
Okay, Shashank. So
Yes, Sumit.
Nivedita, I hope you have started exercising now.
I'll do all household work. No, no need of exercise.
Oh, that is different, that is different, honestly. They need to start exercising, otherwise cold will never leave you,
Mm-hmm.
right?
Okay, Sumit.
See,
Yeah.
see Rahul, he's so fit and fine, always fit and fine. Why? The only reason is because he exercises daily, right?
Mm.
So you need to also, right?
Okay.
Yeah. Cool. Today, both the people from that IT company are missing, right?
Sumit,
Prasad as
Shank has messaged in our study group that he has to go to office, so he'll not be able to attend today's class.
well as Shashank, right?
Yes, Shashank.
And Prasad has also not joined. And yes, so both of them have not joined today. Okay, there might be some work in their office too. Generally, IT companies do not work on Saturdays, Neil. And by the way, IT companies are going through on a stock market. IT companies are going through a very rough phase right now. All the IT companies' share prices are going down. So if I just pull out the chart of, let's see, if you can quickly see some of the IT companies' share price.
Yesterday was a bloodbath kind of scenario in the
Correct.
stock
Yeah,
market.
correct. Yeah, the entire stock market was down.
Reason?
Okay, so the reason is I would like to play the reason actually. Let me open my WhatsApp. I'll show you.
Okay.
I will like to play that, but before that, I will first show. See, yesterday it was down 3 to 4%, right? And if you see 1 month, it is down what?
Oh,
13% in 1 month, right? And it is the case with almost all the tech companies. Same if you see HCL Tech, it is down what? 7 to 8%. Wipro was anyways down, so I don't know if it is down. It is also down 7 to 8%, right? Now let me show you what's the reason. So this is the reason. The US market was down like anything, the Dow Jones. If you go with the song, they were, so the
Nifty.
girl
They're
represents
showing Nifty.
Nifty and the boy represents Dow Jones, which is US market, right?
Okay.
So the US market was down. Otherwise go. Okay. Yeah, so the US market was down almost very largely in the last 4-5 sessions. But the Indian market was holding very tight. In fact, the day US market fell very badly, like everybody was expecting that was, I guess, Friday or Monday. So the next day when market opens over here in India, we all were expecting that it would be a sharp fall. But in fact, that day market rose 500, 600 points in Sensex. Nifty, I do not track. I track Sensex, but that's fine, whichever you track. But now how much it can hold? I don't know. US markets are falling day by day. So I guess it was a catch up. Since all the global markets are falling, how long Nifty would hold itself? So it has also fallen, right? So that is probably one of the reasons. Otherwise, Nehal, I must tell you one thing about the market pundits. Nobody knows why market fall. Nobody knows why market rise in short term. All creates after story. It is very easy to create stories and connect once the event has happened. So if you'll tell me what will happen, Sumit, on Monday, I'll say I don't know. But if you will ask me Monday evening, why did the market went up? I will tell you 3 reasons why the market went up. And if you'll ask if the market has fallen, and if you ask Sumit, why did the market fall? I will also give you 3 reasons. And you will think that Sumit is so smart. But honestly, there is no smartness. Everybody can create stories behind once the event has happened. It's very easy, right? So if, till the time Warren Buffett was alive, sorry, no, Warren Buffett is still alive. I'm talking about Warren Buffett of India. Till the time Rakesh Jhunjhunwala was alive, most of the people were saying he will remain alive, he will remain alive. The day he was dead, and last month on around 14th August, he was dead. 14th or 13th August, he was dead. The day he was dead, everybody was like, ये तो होना ही था, जो बंदा दिन में एक पैकेट सिगरेट पीता है, 5 पैक विस्की के पीता है, वो तो जल्दी मरेगा. He died untimely. So, everybody can create narratives. It's very easy to create narrative, right? So you didn't join the last class, but we created narrative like this. That Nivedita said that I am having cold and cough, and we just checked. I checked with Rahul. Do you have cold? He said no. I checked with Yash or Sham. Do you have cold? He also said no. So I created a narrative. So see that these people are not ill because they do exercise regularly. So narratives are very easy to create. So nobody knows, Neil, why the market fall. Yeah, this is one banking group which I am part of. Don't think that the group is made up of all these kind of thing only, but this was interesting. So otherwise, a lot of serious talks happen on this group. But these kind of things are also part of the group on a funner side. So yeah. Nobody knows, honestly, why the market was down. All right. Cool. Okay, so let's come to swaps. So we were doing swap, and unlike all the other sessions, Nehal, in my last session, I made everybody do an exercise. And today also I will do, So first I complete an example, then I gave a question, and I asked everyone to do it. Everybody took 20-25 minutes, and everyone came up with a wrong answer, including me. I also came up with the wrong answer for the same question. Only one person came up with the right answer. That was Mayank, the one who is in office and who got on Mayank Maldhan. Yeah. So he came up with the right answer. As everyone me. I must stress on this point. But including me, we all were wrong. Only he was correct with respect to logic. So today also I'll try to give some exercises like that. But before that, I'll just give you basic definition of swap because you weren't there in the last class. I will not obviously cover all the aspects, but just a basic definition. And for others, you guys can take it as a quick revision. Right? So what is swap? Swap is a series of exchange of cash flows. So it is not only one settlement which is happening, Neil, where a transaction will be completed by exchanging the cash flow only once. If you are entering into a swap, the transaction would be executed at multiple intervals, and each interval require you to exchange the cash flows. So swap is a series of exchange of cash flows between two counterparties on different underlying assets, not on the same underlying assets. Both the parties have taken different exposure. One asset, for one party, the asset gives fixed return. For another party, there is a different asset which gives them variable return. So on different underlying asset, two parties are entering into a contract which are promising to exchange a series of cash flows on multiple settlement date. So like forwards, futures, options, these swaps are not, unlike forwards, futures, and options, these swaps are not going to settle once and for all. They are going to get multiple settlements. One contract will have multiple settlement dates throughout the life of swap. Right. So that is why the swap are also known as nothing but a series of forward contract embedded into one contract. Multiple forward contract embedded into one contract and bought and sold as one product. For example, 5-year swap. So the life of the swap is 5 years, where settlement is going to happen every 6 months. That means during the life of swap, there are total 10 settlements which are going to happen between the counterparties. 10 settlements. Just read this. 5-year swap, 6-month settlement.
10 settlements. Okay.
Right? 10-year swap, every 6 months there is a settlement due. 20 number of settlements will happen in total. 2-year swap, yearly settlement. Frequency of settlement is yearly. So total number of settlements during the life of swap will be 2.
Okay.
1 year swap, settlement frequency is quarterly. Total number of settlements will be 4. 20-year swaps, settlement frequency is quarterly. Total number of 80 settlements will happen throughout the life of swap. 50-year swaps, every 6 months settlement is due. Total number of swaps, settlements which will happen throughout the life of swap will be
100 settlements. So is there a minimum time frame where the swap has to be like only 6 months, or it has to be minimum for 1 year?
No standardization, all customization.
Okay.
Swap is a pakka OTC product.
Okay.
You will not find swaps on exchange.
Okay.
It is a pure OTC product.
Hmm.
So if we quickly see the difference between OTC, market and somewhere I had covered, I'm not sure where.
I think
Exchange traded market.
exchange traded market we covered.
Let us here. So OTC market and exchange traded market we covered. In exchange traded market, the products are futures, exchange traded call options, exchange traded put options, and listed warrants. Whereas in OTC, call options, OTC put options, forwards, swaps.
Hmm.
The swap as a product is only in
OTC
OTC
market.
market.
Okay.
Another such product, swaptions, is also only in OTC market. Similarly, exotic options or very structured kind of product, very difficult product to build, also only forward contract. Since they are OTC market products, so you can't say there are some rules.
Right.
They can be customized, purely customized.
Okay.
So the point over here is there are two parties who are entering. And now you look at, so there are 6 types of swaps. Equity price return swap, equity total return swap, commodity swap, interest rate swap, cross currency swap, credit default swap. We have covered first three out of this. Today we are going to cover interest rate swap, cross currency swap, and credit default swap. Okay. As we will be going through equity rate swap, interest rate swap now, you would get some more idea on the definition which we have just covered. So here comes the interest rate swap. Two parties, counterparty 1 and counterparty 2. Counterparty 1 we are assuming is BlackRock. Counterparty 2 we are assuming is JPMC. Counterparty 1 is fixed interest rate pair. Counterparty 2 is floating interest rate pair. Oh, Louis has joined now. Great. Great, Louis. We were just looking for you and Prasad, and both of you were missing. So I thought there's some office work which would have come up. But good that you joined.
No apologies.
No, Anisha, thank you. But you haven't missed anything because I was just taking through the after cracking some fun tidbits here and there as we were just going through. But there's one very interesting video I played. I would like to show it to you. So Nehal had asked that why stock market has fallen so deeply on Friday, right? And Louis, I had shown a video on that. I would like you also to watch it. It's interesting.
I will watch it after the session is over. Is that okay? Because I don't want to take everybody's time.
Okay, chalo, that's fine.
Thank you so
much.
much.
Great. So otherwise you haven't missed much. We're just coming with interest rate swap. That was the next topic for us, right? We're done till commodities. Okay.
Sounds good. Thank you.
Yeah. So what would be confusing, Nehal, for you would be that what is this fixed interest rate pair and what is this floating interest rate pair? That would be something which will be confusing, and which I would like to clarify, because once you understand this, things are very easy.
Okay.
See, when two parties are entering into exchanging a cash flow, you need to understand, trade can only happen if the cash flows are different. The value of cash flow is different. For example, if Sumit and Nehal are entering into a contract to exchange series of cash flows, where I say that I will pay Nehal 10 rupees every month, and Nehal also says that I will pay 10 rupees every month to Sumit. Tell me, is there any logic to have this kind of
No.
it would be foolishness, or it would be childish play. Not foolishness, but it can be childish play. Two children are playing, right? Some game. So that is why both parties, if they are paying fixed amount, contract cannot enter. Similarly, if I say, Sumit says that I will pay 10 rupees to Nehal, and Nehal says that I will pay 20 rupees to Sumit. Even in that case, Sumit would not like to enter into a contract like this. Why? Knowingly, Sumit will not enter into a contract where both the parties are paying fixed amount. Because Sumit is not fool to enter into a contract to give 10 rupees. Sorry, Nehal is not fool. Sorry.
Yeah.
Nehal is not fool to give 20 rupees and receive 10 rupees every month. Right? Or there is one possibility where Sumit is playing the role of Godfather, as I told you earlier also. I put a pistol on your head and say you have to sign this contract. Right? Otherwise, this contract is impossible to happen, right? So both the parties making fixed commitment cannot happen, because knowingly both parties will not exchange same cash flows because there is no need of it, and knowingly both parties will not exchange even fixed different cash flows, because one party anyways would be losing. So you would not like to enter into a deal where you are, for all the transactions or all the settlement dates, you are going to lose, right?
Yes.
So in a swap, one of the legs has to be a floating leg, wherein I say that I will pay 10 rupees to Nehal, and Nehal says I will pay a floating rate. Now let's make this example more interesting. Sumit says then that I will pay 10% on 100 rupees to Nehal, and Nehal say I will pay some percentage on 100 rupees, but that floating percentage will be decided based on quarterly returns of Infosys shares. Every quarter, what return Infosys shares gives. For example, Infosys shares, when we enter into a contract, share price of Infosys is 100. First settlement date is 6 months from now. So after 6 months, if the Infosys share price is 150, what is the return Infosys shares has given? 50%, right?
50%.
So that means Nehal will pay 50% of 100. So that rate, how Nehal is deciding? Based on what rate Infosys shares have returned during period of 6 months. Right? So that is how that rate is decided. Now in the next 6 months, Sumit will again pay 10% of 100 to Nehal, but Nehal will check Infosys share price. Infosys share price has gone to 140. That means from 150, it has gone to what? 140. So it has given a negative return. 7% negative return, right? So rather than Nehal paying anything, Nehal will ask for 7% more from Sumit. So Sumit will end up paying 17% to Nehal in this contract, in the next settlement, because Infosys shares have given negative return. Right? So rather than giving money, Nehal will actually take money. Right?
Right. In here, we are considering Infosys share as the underlying asset. Underlying asset can be anything similar.
Underlying asset for calculation of floating rate, which Nehal is going to pay.
Okay.
For Sumit,
It's fixed.
Infosys shares has no value from the perspective of deciding what rate he is going to pay.
Okay.
So for him, the asset is fixed. For Nehal, the asset is a
Floating.
Floating asset,
Floating is.
right?
Okay.
Similarly, Nehal can decide to make the payment not based on some shares return, but on commodity price fluctuation. Nehal says that I will decide what rate I will pay to Sumit depending on how the crude oil prices changes between each settlement date. Starting with $100 per barrel, it goes to, for example, $80 per barrel. So Nehal, rather than paying 20%, it will receive 20% from Sumit on the top of 10% fixed return which Sumit is going to. And in the third settlement date, the crude price goes to 140. So it has given us return of 75%. So Nehal will have to pay 75% of 100 to Sumit.
Okay.
Right? So like this, the first example was the example of equity return swap, and second example was the example of commodity swap. Okay, it will help you when you will go through these videos.
Okay. Sure.
Right. Now comes the interest rate swap. So in interest rate swap, the asset for the floating rate pair will be some interest rate. Like there are fixed interest rates, similarly there are floating interest rate also. Some floating interest rates which are very famous as NIBOR, LIBOR, MIBOR, inflation, T-bill yield. These are some of the floating interest rates which are famous. Okay. So two parties are entering into a contract where BlackRock is saying that I am going to make the payment as a fixed interest, and JPMC is going to say that I am going to pay the interest in a floating interest rate manner over a notional amount of $250 million. So this notional amount is decided to identify the risk exposure of each of the parties, but this notional amount is not going to get exchanged between both the parties. How much every settlement date BlackRock will pay to JPMC will depend on what rate, on what absolute amount. So the absolute amount is fixed to $50 million. The rate is also fixed for BlackRock, but for JPMC, the rate is going to be discovered every 6 months or whatever the frequency is of the settlement date. But the rate into absolute amount will be paid or exchanged, right? So that absolute amount is the notional amount. So the notional amount is risk exposure, which is not going to be exchanged between both the parties, but it would be required to decide each party's obligation in the form of cash flow to be given to other party. Who is a fixed interest rate pair over here, Rahul?
Sir, BlackRock.
And who is the floating interest rate pair?
Sir, JPM.
Correct. Trade date 30 December 2020. Effective date 1st January 2021. Effective date, Nehal, is the date from which the contract will get effective. Right? The life of the swap will start. Here, in this case, swap life is decided between both the parties as what?
5 years.
So, the 5-year life would start from which date?
1st January.
1st January 2021. Notional amount, Rahul, decided between both the parties is how much? $250 million. Rahul, will this amount be exchanged between BlackRock and JPMC by any chance?
No, sir. If no, sir, in this shop, they will not exchange this amount. They will only exchange the net amount.
Rate fixing dates. Now, these rate fixing dates are required, Nehal, for JPMC's liability or obligation calculation. BlackRock is a fixed rate pair, right?
Yes.
So for BlackRock, life is simple. It just have to decide at the time of entering into the contract that what is that fixed interest rate it will pay. And it has decided. It has decided what? 8% per annum. So for BlackRock, life is simple. Problem is for JPMC, we don't know. It's a surprise. And because it's a surprise, that's why it's a contract. Otherwise, it wouldn't have been a contract. There wouldn't have been any contract, right?
Yes.
But how, on what date would it be decided? So that date is called as rate fixing date. Settlement dates are 2nd July and 2nd January. That means what? What is the frequency? Every 6 months, right? From effective date, what is the frequency? Every 6 months. So a day before or 2 days before, rate fixing dates are decided. So if settlement dates are 2nd July, rate fixing dates are what? 30th June. So on 30th June, whatever would be the floating rate, that rate would be the rate which would be paid by JPMC to BlackRock. Now, which floating rate will be looked after? 6-month US dollar LIBOR rate plus 1%. That is the floating rate. So replace it with, Rahul, replace it with either an equity share or with a commodity in our earlier example. This time it is what? An interest rate. In our first 2 example, it was an equity share. In our third example, it was a commodity. Now it is a interest rate itself, a floating interest rate benchmark. It's an interest rate benchmark. The US dollar LIBOR rate, 6-month US dollar LIBOR rate is a interest rate benchmark, which changes every day, Neil.
Yeah.
LIBOR rate changes every day. So the problem is which day's interest rate will be fixed for the payment of
JPMC to BlackRock.
from JPMC to BlackRock.
Okay.
So that date is 30th June and 31st December. That means 2 days advance to the settlement date. So on rate fixing date, that floating rate will be finalized, and on settlement date, that money will be exchanged between both the parties, right? Okay. Yeah, Shravani, I got your message. It's fine. Whatever it is working for you. It's fine. If you are in the session, I hope if you are, yeah.
Yes, Sumit. Yeah, I'm in session with you.
Not an issue. Not an issue. Yeah.
Okay.
Please enjoy the session till the time you are here, right? So 2 people actually, one is Shravani, another one is Shashank. Okay. All right. So now, in case of LIBOR or in case of any such underlying asset, the thing is, Yash, that this asset gets traded on multiple benchmarks. For example, if you want to invest into a company called Jockey, you know, right? Undergarments company. So Jockey is a brand logo under the company name Page Industries. So Page Industries is the name of the company. Jockey is the name of the brand. You can invest in Page Industries on NSE as well as on BSE. That means on Nifty as well as on Sensex. Right? The company is traded, same company is traded on both the exchanges. So what I'm trying to say is that a particular asset class can be traded on multiple exchanges and the prices can be different. That is surprising. The prices can be different and that creates arbitrage opportunity, but the prices can be sometimes different. It would not be very far different years, but they can be different. They can be different. That is why it is important that at the time of entering into the contract itself, it is decided that you will record the 6-month US dollar LIBOR rate on 30th June and 31st December every year for the next 5 years, but on which benchmark? So here they're deciding on which benchmark? ICE is benchmark. And what is ICE? If you guys remember, I had shown you in the last session. Anybody remember? And Rahul, you should be remembering because you had asked this question, right?
There's a intercontinental something. Last year, not remember.
So you enjoy intercontinental food a lot, huh? Right. So what is ICE? ICE is a benchmark administrator, which comes up with the rates like LIBOR, right? It's a group of 16 banks we had seen the last time, if you remember. Intercontinental Exchange, as was rightly said by Rahul, London. So it's a benchmark. It takes an offer rate from 16 different banks globally. And based on that, it takes an average or there's some weighted average mechanism through which it comes up with one rate every day, right? And it changes every day. So this is the scenario. Is the scenario clear to everyone?
Yes, Sumit.
Right. So now what we have to do is to identify the obligation of BlackRock is very easy. First, we have to identify what would be the multiple settlement dates. How many settlements will happen over here? Yes, 10 settlements will happen over here, right? Because the swap life is 5 years and the frequency is every 6 months. So we need to identify what would be those 10 settlement dates. 2nd July 2021, 2nd January 2022, 2nd July 2022, 2nd January 2023, 2nd July 2023, 2nd January 2024, 2nd July 2024, 2nd January 2025, 2nd July 2025 and 2nd Jan 2026. Total how many dates? Count if you count it, 10 dates.
10.
10 dates, right? On these 10 dates, what is the exposure? $250 million exposure. So BlackRock will make a payment to the tune of 8% per annum on $250 million. So if rate is 8% per annum, what would be the rate BlackRock will be paying every 6 months? 4%? Yes or no? 4%? The promised fixed rate is what? 8% per annum. So obligation every 6 months will be what? 4%. So 4% of 250 is $10 million. So every 6 months, BlackRock will be paying. The obligation of BlackRock is how much? 10 million. Huh? So the life of BlackRock is easy. It is easy. In Gujarat, they say Majani life, right? Easy. But JPMC's obligation, how are we going to arrive at that? For that, we will have to observe on 10 different dates, the ICE's LIBOR rate, 6-month LIBOR rate, because there can be 3-month LIBOR rate, 6-month LIBOR rate, 12-month LIBOR rate. You have to look at 6-month LIBOR rate published by ICE as a benchmark. On which 10 dates? 30th June 2021, 31st December 2021, 30th June 2022, 31st December 2022, 30th June 2023, 31st December 2023, 30th June 2024, 31st December 2024, 30th December 2025, and 30th June 2025 and 31st December 2025. This would be the 10 dates on which you would be observing the LIBOR rate, 6-month LIBOR rate on ICE. So for example, these are the respective dates on these respective. These were the respective rates on these respective dates. And all these rates are on what basis?
Yearly basis.
Yearly basis. What would be the obligation?
Rate
The obligation
plus
is 6-month LIBOR rate plus 1%. So if 6-month LIBOR rate was 7.5%, the obligation will be how much? 8.5%. That is 7.5% plus 1% for all these different respective dates, right? Now, but these are per annum rates. Settlements are happening every 6 months. So what would be the obligation for first settlement date from JPMC's side? It would be 8.5% divided by 2 multiplied by $250 million, right?
Okay, right.
Right?
Right.
Try to understand. Yes, I can understand that you would be thinking that we haven't done this 6-month kind of thing for all the other examples. See, here a fixed rate, both the legs are paying rates only. Both the legs are paying interest rates only. In all our earlier example, only one leg was paying an interest rate. Another leg was not paying any interest rate. It was paying the price differentials of underlying asset. Right? So when, for example, the share price of IBM goes from 220 to 235, the return is 6.8%. This is not annualized return. This is not annualized return. This is the return of that time period only. If the difference between these two dates is 6 months, for example, then this is the return of 6 months only. This is not annualized return. You can make it annualized, but that would be foolish exercise. First you analyze it and then again you half it, you'll get the same value. Yes or no? Because of 6 months return is this. What is the annual rate? Multiply by 12. Sorry, multiply by 2. Right? So all these returns were time specific returns only, not annualized return. But here, because the floating rate is also a interest rate, which is published annualized level. So all these 6-month LIBOR rate are published in what fashion? Per annum fashion. That is why we will have to make it half. Why? Because the frequency of the payment is 6 months. Is it clear? Is it clear?
Yes.
So the obligation on front of US JPMC will be for first settlement date 10.625. Now over here you need to understand, Nehal, that BlackRock needs to pay $10 million to JPMC and JPMC needs to pay $10.625 million. Both the people have to exchange this in the same currency, right?
Yes.
The obligation which needs to be paid by each of the parties in same currency, right? Because they're in the same currency, there is no point that BlackRock actually transferred $10 million, JPMC actually transferred 10.625. As an adult, they can settle this transaction on net basis. Right? Because they understand that BlackRock giving 10 and JPMC giving back 10.625 basically means JPMC is actually giving 2.625 on net basis, right?
Yes.
So all the settlements will happen on net basis in swap, with one exception. If the settlements are to be performed in 2 different currencies, that means BlackRock needs to make the payment in one currency, which is different from what JPMC needs to make the payment in. If the currencies of the cash flow which needs to be exchanged are different, in that case, the settlement will happen on the gross basis. Rest in all the other cases where the currencies to be exchanged are same, or the cash which needs to be exchanged is same in the same currency, then in that case, settlement will happen on what basis? Net basis.
Net basis.
Right? Now, again, for the second settlement date, what is the rate of LIBOR? 6.5. So what would be the effective rate which needs to be paid by JPMC to BlackRock is 7.5. That is 6.5 plus 1. Right? And the interest rate which will get due will be 7.5 divided by 2 multiplied by $250 million. That is $9.3275 million. That means net payment will happen from BlackRock to JPMC to the tune of 10 minus 9.375, that is $0.625 million. From BlackRock JPMC. Like this, you will do all the calculation in all the areas where actually the rate is more than 8%. That net transfer will happen from JPMC to BlackRock, and when all the cases where net rate is less than 8%, net transfer will happen from BlackRock to JPMC. Right? Make sense? Yes or no?
Yeah.
Right? A bumper payment, for example, the last settlement date, the rate actually jumps to 10.25%. So a bumper payment you can see is happening from JPMC to BlackRock. Why? Because JPMC is almost losing $2.815 million in this. Right. So like this, if you will check, total receipt for BlackRock is $8.4375 million. Total payments from BlackRock is $4.6875 million. So over a period of 5 years, the net profit which BlackRock has made is total receipt minus total payment, that is $3.75 million. Is it clear? So in this case, it seems that BlackRock has won by entering into this contract. But who knows how the interest rate trajectory would be? BlackRock was thinking the interest rate trajectory on LIBOR would be high. That is why it has entered into a contract where it has to pay its fixed rate, but it would be receiving a higher interest rate in the form of increased LIBOR, because that was BlackRock thinking. Was BlackRock correct in his view? Yes. What if BlackRock had a view that LIBOR will go up? That was a bullish view on LIBOR, but actually LIBOR had kept on going down. What would have happened? BlackRock would have lost a lot of money. And who would have won? JPMC. Right? Because loss of BlackRock is gain of JPMC. Stock market trading, yes, is a zero-sum game. Why it is a zero-sum game? Forwards, contracts, anything. All these are zero-sum game. Why? All the financial instruments are zero-sum game. Why? Because there is no real productivity which is happening. There is no raw material which is getting converted into finished goods and which is getting utilized as iPhone mobile or medicine or anything. Wherein actually, if you are struggling with the fever and you go buy medicine, it's not a zero-sum game. It's a win-win game. Because company wins by selling Dolo to you and making money. You win by buying Dolo and consuming it and removing your fever. You're overcoming your fever, right? So both the parties, it's a win-win game. But stock market is a zero-sum game. That means what? No new money is getting created. One party's loss is other party's gain. That's all. No new money is getting created. In the primary market, it's not a zero-sum game. It's a win-win game. Why? Again, company in the primary market, when it issues the securities for the first time, what is the purpose? The purpose is to raise the capital and put and deploy that into the business, into the working capital to meet the working capital requirement or capital expenditure requirement. That means buying the assets, utilizing that assets in manufacturing goods and services, right? But in the secondary market, when things get traded, they are zero-sum game. One party's loss is another party's gain. Every person buying the stocks thinks that there would be another fool who will buy it at higher price. That is the underlying assumption. When I'm buying a share, what I'm assuming now, that I will get a bigger fool who will buy it at a higher price. And the next bigger fool is as when he is buying or she is buying the shares, he thinks that there would be another bigger fool who would buying it at a even a higher price. That is the underlying assumption with which you buy the house. And that is why stock market is also known as a big fool theory. Right? Trading market I'm talking. Not the primary. Primary market, you are really investing into something productive. Because company who is going to consume that capital is one of the parties. In secondary market, company is not the party. Two individuals who have nothing else to do. 9:15 market opens, shorting the shares of CIBOP tires. 9:45 buying it back. Shorted it at price of 1744 rupees. Bought it back at 1683 rupees. Made a profit of 60 rupees per share. Shorted total 1000 shares. Made a profit of 60,000 rupees. No product. 40 minutes made 60,000. Enjoy your day. Watch television. Whatever you like to do. That is what stock market trading is. Another day you re-enter the market. You short the shares again of CIBOP tire at 1680 rupees, thinking that it will come down and I will buy it back. But that day it go and touch 1900 rupees. And you lose 2 lakh rupees. You do not watch TV. You fight with your wife, with your spouse, with your children, with your friends. You cry the whole day. Right? And then the next day comes, again the journey starts. So they are not doing any productive things over there, Nehal. They are not entering into a contract with some vendor, give me the raw material, and they're not contracting with the transport companies that is the delivery on time or not. They are not connecting with any customer to understand what is your taste, what is your flavor. And they are not connecting with the designing team who is going to design the product in the kind of taste and flavor of the customer. That whole thing is not happening. Only watching TV like pig is happening. All the time eating, watching, consuming entertainment. Right? Why? Because in first 40 minutes of the day, you made 60,000 rupees. You enjoyed. Next day, you lost 2 lakh rupees. You cried. So you are either on this extreme of the emotions, euphoria, or on the another extreme of the emotions of pessimism. Some people get so negative in their emotions that they commit suicide. Right? And some people go so positive in their emotions that they start consuming drugs. So that is another kind of suicide. Right? So in both the extremes, it is suicide only. Right? So that is why it's a zero-sum game. Your loss is my gain is your loss. Right? Both ways I am gaining. Right? So that's how everyone thinks that I am smart. I am smart. But no one is smart. Market is smart. And that is why traders generally die poor. Investors, on the other hand, might be playing some positive role, I would say, in terms of investment, because they are really providing capital to the companies for a very long time period. So that's fine. So I got into a different trajectory altogether. But yes, that's what the market is all about, right? From a trader's perspective. And I'm not a trader. So that is what interest rate swap is. Any question on it? Because the question is waiting for you guys. So you ask, tell me if there's any question. Otherwise, the question is waiting for you guys. Okay. So I quickly brief it again. What is happening that there are two parties who are entering into a contract to exchange the interest rate here. One of the parties is entering into a contract to pay a fixed interest rate. Why? Because he thinks that the floating interest rate will keep on going upside. So let me pay fixed and receive floating. Because floating will keep on going up and up. I will keep receiving more and more than what I would be paying less and less. Or I would be paying actually same, but would be receiving more. Right? That is what the view of the fixed rate pair. Another side, there is a floating rate pair who thinks that the floating rate will keep going down and down. We are entering into a downward interest rate trajectory. That's what his feeling is. And that is why he thinks that let me receive fixed and pay lesser every settlement date. because floating rate will going down, down, down. So he has a JPMC over here has a bearish view on the LIBOR 6-month LIBOR, whereas BlackRock has a bullish view on the 6-month LIBOR. Entered into a trade, interest rate swap, trade date, effective date, underlying assets are interest rates, two different interest rates. Fixed interest rate and floating interest. So underlying assets are two different underlying assets. Notional amount, that is risk exposure, on which these interest rates will be charged to calculate the obligation for each of the parties. Rate fixing dates needs to be decided. Otherwise, how would you decide which floating rate? Otherwise, keep on changing every second, every minute. Settlement dates needs to be decided. Swap life. Settlement date, fixed interest rate. What is that rate which fixed interest rate pair will be paying? Floating rate interest rate ke liye you need to decide the benchmark. That is 6-month LIBOR rate plus 1%, and traded on which index? Traded on ICE administrator index. And then on these respective rate fixing dates, you decide what would be the floating rate to calculate the obligation on front of JPMC. Obligation of BlackRock is to be calculated very easily because it's a fixed rate. When you are playing with interest rate, always remember interest rates are quoted on annum basis. So if you have to pay quarterly, then you divide the interest rate by 4. And if you have to make the payment half yearly, you have to divide the interest rate by 2 to calculate the obligation of each of the parties. And that is done. Is it clear?
Yes, Sumit.
Then this question is waiting for you. Solve this question. Tell me how much Bank of America Merrill Lynch will be paying on net basis and how much it would be receiving on net basis, and what would be the ultimate gain of Bank of America Merrill Lynch or ultimate loss of Bank of America Merrill Lynch. All the terms of the trade are written over here. I would not discuss it. You need to read it and understand it by yourself. The time is for yours. Try to solve this time, Rahul, on Excel if possible. Not that pen and paper is fine, but last time also I showed when you do it on Excel, a lot of calculation becomes easy to calculate. Otherwise, it's your choice. So now the time starts for you guys. I would sit back, relax, chill, enjoy. Is it done?
Yes.
All right. Tell me the answers then.
My net answer is 11.633 million.
So
The net
Yash,
amount.
Yash is say 11 net amount 11 point.
633 million.
Who will pay to whom? Net basis pay.
Barclays pay to Bank of America.
Barclays is the winner by 11.633 million, right? No, sorry, Barclays.
BOML.
BOML.
BOM.
BOML is the winner
Yes.
Hmm.
Yeah.
with a net gain of 11.633 million. Okay.
Yes.
What about others?
For me,
Hmm,
it's 11.6375.
Hmm.
Barclays to pay to BOML, so BOML is the winner.
ठीक है.
I got the same answer. 11.6375.
Okay. So I guess for yes, the value is only a bit different. Rest. What about you, Rahul?
Actually, I did some I haven't round figured some amount, so it may
Acha.
be some chances there.
Okay, I need some time. I'm doing. Who? Rahul, you're doing right? Okay, so give Rahul a couple of more minutes. See if we can reach to some level. What about others? Kamesh, Ramesh, Sujata, Richa, Ayushi. I'm giving you guys a couple of more minutes. Just complete.
Sumit, I'll be back in a minute.
Yeah. All right. I guess we should now see if Rahul has done. Rahul, have you done it? Rahul, have you? Oh, yeah.
Yes, sir.
Have you done it, Rahul?
Yes, sir.
What's your answer?
So 11.8125.
Let me write it down. 11,
Point
11.8.
1. 11.8125.
ठीक है. Right. ठीक है. So let's try to solve it. Let's see if we can solve it. So first of all, how many swap? Swap life is 4 years and quarterly settlement
Quarterly.
date. Hey,
Mm.
it's quite
Sir.
longer one. Okay. So let's write down the settlement dates. 2nd April,
2nd July.
2nd July. So rather than writing them down, let's link it from there. Swap life is 4 years. So there will be total 16 settlement dates.
Yes, Sumit.
Effective date is 2021 January. So April, July, and October will be in the same year. Then comes 2022.
Hmm.
Then comes 2023. Then comes 2024. And the last year. Right. So now let's identifying the obligation of BOML is a fixed interest rate pair, right? It's
Yes.
very easy. It would be equal to obligation would be equal to
Quarterly of
10
10.
percentage divided by 4.
2.5.
Right? You can fix this rate FF4 into 350 million.
8.7.
Right?
Yeah.
And then we need to calculate the obligation for Barclays.
Barclays.
For that, we are given the rate over here for LIBOR rate. So we need to take care that floating rate is not only LIBOR rate, it is LIBOR plus 3%. So actually it will be this rate. The effective rate will be this one. So we can calculate the obligation by simply, this is quarterly, right? So
Yeah.
say 15 million FNF4 into this divided by 4. So all this Barclays obligation is calculated. Now we just need to decide who will make the net payment. So net settlement amount would be the first year, it would be Barclays minus BOML. Barclays will be making the payment to BOML, right?
Yes.
Receiver will be BOML. Payer will be Barclays. Okay, so same will for this also, this also, this also, this also. Is it the same for till here?
2nd April 2023, it's changing.
Yeah, here it will be changing for the first time, where the payment will be made by Barclays to receiver will be Barclays and payment will be made by BOM. Here will be B1.
Yeah.
Then here also it would be the same case. But
Now it's
from here
changing.
onward, the trajectory will change. Right. Again here, it will become BOML will be the receivable and Barclays will be pay, right?
Yes.
Am I doing? This BOML. Okay. For all the transaction, it would be the same, right?
Yeah.
So now we have the setup ready. So net receive, so for BOML, net receipt will be equal to sum of all this plus sum of all this. Net payment should be net receipt. For net payment, it will be equal to sum of this, right?
Yeah.
The total net receipt positive net gain it will be. Is 11.465. So where am I going wrong, or if you guys are going wrong, tell me.
I didn't do like this net receipt, net payment. I just totaled it out, how much BOML has to pay and how much Barclays has to pay.
Even in that case also, it would give the same value, right?
Yeah, 140 and then
Whichever way you do, it has to be 11.462.
15.
You do it on net basis or you do it this way because mathematics has same hoga. Has to be same. So where am I going wrong? Tell me.
It may be of round off issues. Like in your Excel, there are around 5 digits after the point, and I just carried out 3 digits only. So maybe there's some.
For me, it's 4-digit
Yeah.
maximum.
But the point के बाद में जो पहला 4 है ना वही अलग है. समझ रहे हो मेरी बात को? अगर मैं इसको करूंगा तो भी ये 4 ही रहेगा. Even if I make it 3 digit, तो भी ये point के बाद में पहला digit, the first digit just after the point will remain 4 only, right? And it creates a huge impact. First decimal तक तो it has a huge impact because given these numbers are $1 million. So let's try to find out where am I going wrong, right? Because a lot of people are getting this response because it is not possible that I am correct. It is chances are that you guys are correct because Yash, Nehal, Nivedita, all of you guys are getting 11.6 at least. Forget about second and third decimal. वो ठीक है. But for till first decimal you guys are getting same values. Rahul का थोड़ा off है तो Rahul को मान के चलते हैं कि he would have done some mistake. But given that you most of you people are getting 0.6, so let's check these values. So BOML का तो सबका 8.75. Is it true correct for at least for BOML? मेरे को थोड़ा screen बड़ा करने दीजिए ताकि you switch values.
The second value 9.88. Why it is 9.84 in your case?
For you it is coming as 9.88.
Yeah, for me 9.887.
Me too.
ठीक है तो ये वैल्यू गिराऊंगा ना तो ये अभी चेक.
The next value is also the wrong one. In
Okay,
my case,
so
it's
I tell you why. What is the mistake? The thing is that this value is 8.25, but you would have used this value as 8.3. So you would have considered this as 11.3.
Yeah, 11.3.
Actually, then this is again my error. I should have given it up to 2 decimal, right? So दो जगह पे your values would have been different. It to 7.95 because you would have considered this 7.95 actually 8. You have considered this rate as 11, right? So even this rate will be different. ये दोनों rates will be different for you, right? Okay, so this is an error on my side. I should have given the number till 2 decimal points. Okay, then I guess we all are correct. Given that you had used this information, you had used the information till the 1 decimal. So obviously your answer would be a bit different because I use these decimals in my. But since I'm doing on the same Excel where I have framed the questions, obviously I'm using these decimals actually. I should have used this decimal. I should have shown this decimal. So where our values will be different will be these 4 places. In 4 जगह पे हमारी वैल्यू थोड़ी सी डिफरेंट आएगी.
Sumit, here per 10% per annum, why you have written 5% here? Did we?
That's deception. Because a lot of people do not understand the question, but what they do is they just quickly see कि 5% है चलो करके रखा है तो 5% पे calculate कर देते.
Okay.
So this is a deception, which you mostly will find in all my questions. I enjoy it when I create questions for university exams and when I create a questions for CA, CFA exams. In this, we don't create much of the questions as such in this course, but so I create a lot of deceptions like this. Okay. Any question, guys? Anyone?
No.
As such, not any questions, but this one seems to be bit more easier than the previous ones. I'm not quoting that the previous ones are the hard, but in terms of calculations, this one are bit more easier. Like
दो चीजें
we
हैं.
don't have.
दो चीजें हैं. When you start building muscles, you start with, for example, 5 kg. First day when you pull 5 kg weight, you'll find it tough. But if you are doing it for the 10 days at a stretch, on the 11th day you will find कि boss थोड़ा weight बढ़ाओ यार, 5 तो अभी ऐसे बहुत easy लग रहा है. So because there is already a prequel to it, you already have solved one question. Now you find this one easier. अब अगर मैं equity वाला दूंगा तो you will find even that was more easy. The thing is here, because one more reason for this, you find this question easier. Why? Because direct rates are given. There you have to do another level of another step of calculation where you have to calculate these rates separately, especially in the case of equity total return swap. Though Nehal wasn't there, though she's saying yes, but she wasn't there. But for equity total return swap, who were there in the class, they know that you have to do 2 level of calculation. One, you have to do calculation for the return based on the capital appreciation, and second, you have to do calculation mixing dividend into it. So वो calculation आपको बच गया इस बार. Because I have given these rates directly. Because अगर LIBOR rate है तो directly हो गई. That has to be direct rate you will have to pick, right? So from that perspective, yes, ये थोड़ा सा. ठीक है. थोड़ा और इसको ब्रॉड में देखेंगे, इसके आफ्टर इफेक्ट्स. We will also see the after effects. It is not that always Barclays kind of company or BlackRock kind of company are playing it with from the perspective of speculation or make some upright money. Corporates also utilize this product of interest rate swap to get understanding. Let me put it other way. Let's forget everything about all this. Investor, when they invest into equity market, what they value the best is called certainty. If you are certain that the company is going to make 20% growth, as compared to if you are not certain that what growth it will make, you will find that the first company where the certainty is more is getting traded at a very good value as compared to the another company which is not giving you certainty, but at the end would be growing at the same rate. But because the certainty is not there, you will find that company's stock price trading with a lot of fluctuations. I'll show you two graphs. So if you'll see the 5-year chart of this company, in fact, if you see the maximum chart of this company, it's kind of a one-way ticket on upside. There is one bigger event which you can see, that was a corona event, which is completely reflected in this chart, which resulted into a huge disruption. Otherwise, you will find that it's a one-way journey, because from last 10 years, 20 years, it is certain that HDFC Bank is going to grow at 20%. It is a certain thing. It has kept on doing it. On the other hand, if you will compare it with the chart of IDFC First, see, the journey is not one-way ticket. It is up and down, up and down, up and down. Started its journey at what price? Today it has reached to that same price only over a period of 7-8 years. If you see, it started its journey somewhere at 70. Today it is at 51. At some point in time, it has reached to 70 also, 66 also, okay. Somewhere it has reached to, but it is a up, down, up, down, up, down. Why? Because certainty is not there. Sometimes it grows at what rate, sometimes it grows at whatever rate. Certainty brings a lot of calmness. A certain mind will be a calm mind. भले फिर वो दुख हो या सुख हो, अगर आपसे पहले से पता है कि ये दुख आने वाला है, in the sense if you already know that this problem is going to come, you will be ready to fight. But if that problem comes as a surprise, that creates a problem. That creates a mental problem. There's a problem which is outside, and there's a problem which you perceive that as a problem. So when you already know that a problem is going to knock your door, and if you know it already, you would be ready to receive it. You would be ready to receive it. You will be calm. But when your problem knocks your door without any earlier certainty, earlier knowledge, it may destroy you internally. तो प्रॉब्लम से बड़ी प्रॉब्लम यहाँ आ जाती है, साइकोलॉजी है. Because investing, Yash Kenya, is not about playing with money and playing with numbers. Investing is as much number as much it is psychology. If you ever go ahead and do CFA, you will find that when you will reach to the advanced level of CFA, so in CFA there are 3 levels, level 1, level 2, level 3. The level 3 is pure psychology. So when you go at advanced level of CFA studies, you will find it's pure psychology. Level 3 students will not play with numbers anymore. Level 1, level 2, they are playing with a lot of numbers, quants, ये formula, वो formula, cheat sheet दे देंगे, ये कर देंगे. Level 3 में आएंगे, all psychology. So you cannot take away psychology from investing. Otherwise, stock markets charts would not be there. If there is no psychology, the chart will never go up and down, up and down, up and down, because this chart is not what company's performance is. This chart is replica of how people perceive company's performance as, or what company people perceive the company's performance will be. So when this share price is gone up in last 1 month from 45, in fact, last 1 month from 45 to 52, Why it has gone from 45 to 52? Not because in this 1 month company has done such a super duper hit. In fact, in 1 month, the company has not published any number. Company last published its number last to last month. This share price of this company has gone up because people think that in the next quarter, company is going to come up with super duper number. So this in the share price is the perception of the market with respect to future performance. And perception is nothing but psychology. Everybody will perceive the same message differently. Why? Because everybody's psychology is built up with respect to his or her experiences. Everybody's psychology is different. So you cannot take out psychology, you cannot bring out psychology from the investing. And if people are certain with respect to any particular company, you will find that company's price will always remain range bound and will always go one side upward. Similarly with Kotak Mahindra, bank share price, fairly stable. You will find the chart fairly stable on a long-term basis. Fairly stable, one way again journey. Clearly visible, there is this one event of coronavirus which happened. That's fine. Rest, you will find one way journey. There are many like companies like this. For example, I'm not able to recall the names, but there's this company called 3M India. One way journey. Similarly, there's this one very good American company, MNC working in India. One of my brothers work over there. I'm not able to recall the name right now. But there are many companies such, for example, MRF. A lot of certainty are there when you are evaluating these kind of companies. That is why the charts will reflect that calmness, the certainty very easily. For that matter, if you look at Infosys, I like HCL Tech more than Infosys. I'm biased towards it, but let's look for HCL Tech. Barring some recent this, but if you'll find a lot of certainties there, one way ticket to upside. So the point I'm trying to make is that since investors like certainty, management also knows that investor likes certainty. And that is why management wants to keep things certain. If, for example, yes, you are the management of a company and you need to borrow money to grow your business, but you are getting an option to borrow money at floating rate as compared to fixed rate, where will you be more certain? Where will your balance sheet be more certain? When you have a floating rate interest rate or fixed rate interest rate?
Fixed rate interest rate.
Right? Fixed rate interest rate. So certainty. Things which are fixed bring certainty to the business. Rent brings certainty to the business because it's almost fixed, right? So it's not that interest rate swap is utilized as a tool of making speculation always. It's done with a perspective of hedging also. So here comes an example. Look at this company, GM Motors. Company's balance sheet has a floating rate bonds to the tune of $500 million. What is the problem in the life of GM Motors? The problem is they do not know how much coupon or interest they have to pay every year. Or if it has to be paid quarterly, whatever the payment terms is. Let's see what is the payment term. yearly. The problem is because it has to pay 6 month plus LIBOR plus 1% to its lenders, it doesn't know what it will be paying for all the next 5 years as interest, right? How it can bring certainty? By entering into a contract where it actually do not pay floating rate, it actually pay a fixed rate interest and receive a floating rate interest. So there are multiple parties over here, Nehal. You need to now you will be seeing not only from the perspective of counterparty 1 and counterparty 2, you are entering into the life of counterparty 1 and trying to understand what problem counterparty 1 is struggling with. So there are no more two sides of the coin. There are 3 sides of the coin now. One side is GM Motor. Second side is lenders to GM Motors, from whom GM Motor has borrowed in the real life $500 million. And third side is the investment bank or the dealer with which GM Motor will enter into a swap contract, BOAML, Bank of America. Problem with GM Motor is this, that GM Motor wants certainty in its life. It doesn't know what would be interest cost would be. It doesn't know it. And to resolve that problem, it enters into contract. It wants to sleep with the point that it has to make a fixed interest rate. So as a net payer, it wants to pay a fixed interest rate. It wants to pay fixed interest rate. So it enters into a contract with a dealer where it will receive a floating rate from the dealer and make that payment to its lender immediately. So it is receiving from one person, paying it to another person. But from its own pocket, it is paying a fixed rate. So the problem with GM Motor is this, that in its balance sheet, there is a loan which is at a floating rate. It wants to bring certainty to its life. So, and project its interest cash flow on fixed basis. So it enters into a contract, say, hey, I will be paying fixed interest rate and you will have to pay me floating interest rate based on 6 month LIBOR plus 1%. Right? What is the loan amount? $500 million. So obviously GM Motor should take a risk exposure of how much value? $500 million. So the notional amount which GM Motor should choose is how much? $500 million with the dealer, BOAML. Can it go for lower notional amount? Yes. In that case, you will see if it goes to an amount lower than its risk exposure, it has a risk exposure of $500 million, but it goes for an amount lower than $500 million, then you will say GM Motor is going for hedging, but partial one. If it is taking a risk, notional amount equal to its risk exposure, then you will say GM Motor is going for hedging fully. So when the risk exposure and notional amount is same, it is considered as a full hedge scenario. When the notional amount is lower than the risk exposure, it will be considered as partial hedge. Right? So in this case, for example, it is going for a full hedge scenario. GM Motors is entering into a full hedge scenario with BOAML on a trade date 31st December 2020 with a notional amount of $500 million, fixing a rate of 8.25% per annum to be paid by GM Motors to BOAML. Whereas receiving a floating interest rate with a benchmark rate of 6-month LIBOR plus 1% from BOAML. Swap life is 5 years. The swap life, what swap life GM Motors would like to enter with? The life of the loan. If the actual loan which GM Motor has taken from its lender is for 5 years, so obviously it would enter into a swap also for 5 years. If it is entering for a lower tenure, then that will also be the case of partial hedge. Right? Floating rate is decided. Now, rate fixing date needs to be decided. Rate fixing dates are, for example, 31st December of every of the year. And settlement date is 2nd January of every year. Okay? So see how the payoff will happen. First date, 2nd January 2021. GM Motors should pay how much? 8.25% of $500 million, right? Right? To whom? To BOML. Right? On the same day, it also need to pay 6-month plus LIBOR plus 1% to its lender in real life. Away from this swap transaction, in real life, GM Motors Nivedita needs to make the payment to the tune of 6-month LIBOR plus 1% to be charged on $500 million to its lenders, whom it has borrowed money. The two lives parallelly going over there, right? But first it will settle this swap contract and then it will settle its real life contract. So here in derivative contract, GM Motors required to pay how much? $41.25 million to BOAML. And BOML needs to pay 6-month LIBOR plus 1%. On 31st December 2020, which is the rate fixing date, 6-month LIBOR is 8.5%. So what is the rate which BOML will be paying to GM Motors? 8.5% plus 1%, right? Yes or no? That is 9.5%. So the calculation is 500 into 9.5%. Right?
Excuse me,
Yes?
sir.
Yeah.
Can you repeat from their floating rate 6 months LIBOR plus 1% from where
Yeah.
BOML is hedging?
So 6-month LIBOR rate is 8.5% on rate fixing date. Okay. But what rate BOML has agreed to pay? 6-month LIBOR plus 1%. So 6-month LIBOR is 8.5. What would be 6-month LIBOR plus 1%? 8.5% plus 1%, right? The person who asked the question needs to remain
Yes, sir.
unmuted
Yes,
and
sir.
tell
I'm
me yes,
listening.
right?
Yes.
Now, so what would be the obligation on the part of BOML? The obligation on part of BML would be how much? 500 into 9.5%,
9.5%.
right?
Right.
So that is equal to 47.5, right?
Cool.
So how much net payoff will happen?
The difference
BOML will
between
make the net payoff of $6.25
6.25.
million, right? Now, come to the real life. How much exactly GM Motors needs to pay off to its lenders? 47.5, yes or no? Why? $500 million into 6 million, 6-month LIBOR plus 1%, right? 6-month LIBOR plus 1% is equal to how much? 9.5%, right? How much it has to pay? 47.5. But out of this 47.5, how much exactly it is receiving as a part of IRS contract? It is receiving 6.25%, right? As a part of this IRS contract, interest rate swap contract.
Yes, sir.
Right? So what is the net payoff from GM Motors? 41.25. Yes or no? To its lenders. What is the net payoff to its lenders? 41.25. Yes or no?
Yes,
It
sir.
has to pay 47.5, but since it is receiving 6.25 as a part of settlement day, its net payoff will be equal to what it aspires to pay off. That is 41.25, right? Similarly, let's look on this let's look on the second date. What is the second date? Second date fixed cash flow payment is 41.25 as per IRS contract, but floating rate is how much? 8.75. So, which is equal to 9.75. That is 6-month LIBOR plus 1%. 9.75%. So BOML will obligation is to pay 48.75. That is 500 million into 9.75%. So how it will be settled? It will be settled as BOML paying the difference value to GM Motors, which is equal to 7.5 million. Now, parallelly, GM Motors need to pay 6-month LIBOR plus 1% full value to its lenders. That is equal to how much? Again, same 48.75. That is $500 million into 9.750%. That full value, absolutely, it has to pay to lenders. But out of this 48.75, it has received 7.5 from BOM. So its net cash flow from its own pocket is limited to 41.25 again, right? So by entering into this contract, you can easily see that the net expense for GM Motors is capped at 41.25. It is, if its actual expense is more than 41.25, then that balance amount is coming out of this contract from BOML. Now see the fifth date. Well, on the fifth date, again, the fixed cash flow as per the contract is going to be how much? 41.25. But what is the rate on floating rate on fifth payment? 5%. So what would be the 6-month LIBOR plus 1% rate? 6%. So actual outflow will be how much? For BOML, how much money has to be, or what is the obligation of BOML? 6% of 500 million, right? It is 30 million. So in this case, who will pay to whom as a net settlement?
PM to pay to Bank of America.
GM Motors will pay to BOML how much? 11.25, right? Right. Now come to the real life. In real life, also as a part of fifth coupon payment, it has to pay how much? 6-month LIBOR plus 1% of 500, which is equal to how much? 30 million. So this 30 million absolute value it has to pay to whom? To its lenders as interest, right? But it's still its net cash outflow will remain as 41.25. Why? 30 million it paid to its lenders and 11.25 it will pay as a part of this IRS contract to BOML. So net outflow will remain 41.25. So if floating rate goes down the fixed rate, still the net outflow will remain fixed for GM Motors. So irrespective of what floating rates are going up and down, whatever it is happening, for GM Motor, the expense gets fixed at 41.25. And that was the reason for GM Motor wanted to make it expense fixed, because floating has a risk. Now GM Motors can do better cash flow planning, right? Yeah. Now it exactly knows that every year it will have to earn how much to pay off its interest by entering into this contract. So this is the real type of purpose of these contracts from corporate's perspective, to put their a cap on their interest outflow. All right. Any questions so far? Tell me. Any question? Come on, tell me. No question, guys?
No, Sumit.
All right. So let's take a break then over here for 10-15 minutes, and let's come back and we will cover the other aspects of swaps, other two types of swaps which are left, which is cross currency swap and credit default. Yeah. All right.
তখন উঠতে উঠতে আমার চোখ সামনে কি হচ্ছে চিকেনে মুড়ি দিয়ে ঘুরে বেড়াচ্ছে আর বলুন হচ্ছে কি হয় না হ্যাঁ হ্যাঁ বছরের মাংস খেয়েছি নিচে নিচে खाली जाने का प्लान कर रहे हो? हाँ, 5 तो फॉलो हमने बैंक में जरूर तुम्हारा घर जाने का नहीं बन जाएगा
सर बस कैंसिल है जिसमें जाते
तो बैठ तुम
कौन बैठे कल सुबह जाएंगे क्या कॉल करना था
बोला তুমি তাওরা নিচে জানেন না তো আমি জানি না আমি একবার আসলে ও আমি অনেক সময় ও খুব মানে একটা বুঝতে ভালো কথা আমি আমি থেকে জানে আমি লোন অ্যাপ্লাই ওই অনলাইন দেখাই না
वो एप्लीकेंट रहने सर को एप्लीकेंट भी तो पानी पूरी खाएंगे लाते
All right, friends, let's start. Are you guys back and can you guys hear me?
Yeah.
Yes, sir.
Cool. So the next in line is the one which has all the exceptions possible in case of swap. So while we were going through features of swaps, we had noted that notional amount is not exchanged. It is only the risk exposure, and it is never exchanged between the parties, except cross-currency swap. Similarly, we had said that settlement happens on net basis for all the different types of swap, except again cross-currency swap. Because in cross-currency swap, the currencies are different for both the parties. And that is why settlement has to be happening cross. So cross-currency swap, the mother of all the difficulties, cross-currencies. But as I told you, once you see it, it becomes easy. So cross-currency swap basically requires you to look at swap from the perspective of two different currency. It is like borrowing the currency which we desire to possess and lend the currency which we want exchanged. And when we see the example, it will make a lot of sense to you. The important point over here is that principal notional amount gets exchanged between both the parties. The first settlement actually is the exchange of notional amount itself on the effective date itself. And then there is a set of cash flows with respect to interest rate and interest payment over the life of the swap. And there is a final settlement, which is again the re-exchanged of the principal notional amount. So unlike all other swaps where we saw that there is a series of cash flow exchange with respect to fixed rate pair to floating rate pair and floating rate pair to fixed rate pair, here there are three levels of exchange. One, the notional amount gets exchanged between both the parties. Then there is a series of cash flows which happen with respect to the interest payment. And then again, the final settlement is in the form of re-exchanging that notional amount, which was actually first exchanged at the type of effective date or when you entered into the contract. We need to understand the reason for the existence of something like cross-currency swap. The basic reason is expansion, geographical expansion dreams of corporates. That is the basic reasons for cross-currency swaps to exist. A company called IBM, which is purely a US-based company, has a hunger to grow beyond US. It wants to grow in UK, for example. In order to expand its business in UK, it can't go with dollars. It needs to go with UK pound. It can't pay the salaries of the employees who are working in UK in dollar. It needs to make that payment in pound. If you guys remember, I have talked something called as when we were talking in equities and cash equities, there we had talked about one particular kind of equity where you can go into another market and raise capital in that market's currency. American depository receipt, global depository receipt. That is another way IBM can go to UK and raise capital in the form of equity or loan from UK banks in GBP. But the rate at which IBM will get the interest will always be higher than the rate at which a UK-based company will get loan or money from that market, because they are familiar. If I am an Indian, I have to choose between Infosys and Microsoft. It is easier for me to choose investment into Infosys because it is much more familiar to me. Similarly, if it is a UK oriented bank, it has to choose between IBM and British Petroleum. It may rather choose British Petroleum over IBM because British Petroleum belongs to UK. The roots of that company is in UK. You can access to the management easily because they are UK based. Otherwise, it's too much of risk. When you lend money to global geographies or global companies, there are many rules and terms and conditions which comes into play. And what if you trust an Indian and then Indian turns out to be Vijay Mallya? Being a UK bank or being a US bank, you have given and extended your support and lending money to someone like Vijay Mallya. Try to understand. International land will have international laws. So many confusion. Which court you go and ask for, that contract at the time of Vijay Mallya says no to give back the money to you. There are so many confusions, so many problems. And that is why there are two important risks. Even with the companies which are equally rated, but since they do not belong to your geography, you need to charge a higher interest rate as compared to a company belonging to your geography with the same rating, with the same profit. You need to charge a higher interest to cover two kinds of risk: political risk and sovereign risk. Political risk and sovereign risk of a country which is not your country has to be factored in. And that is why an IBM going to UK, raising capital from UK banks, will get an interest charge which would be higher as compared to British Petroleum being in UK, taking a loan from UK bank. So if British Petroleum being in UK raise capital in terms of GBP in UK market, if banks are charging in 6%, the same bank will at least charge 7% to IBM when IBM goes to UK market and raise capital or loan in GBP denominated currency. Look at it very carefully. British Petroleum, being a UK-based company, going to a UK-based bank, asking for a loan in UK currency, will get an interest which will always be lower than IBM going to UK and to a UK-oriented bank, raising capital and borrowing money in UK's currency, in UK's market. Right. Similarly, British Petroleum is also have a dream to grow globally, right? So British Petroleum already have its Samrajya in British. Now it wants to expand its business to US. So it wants to go from UK to US. Same challenge. We are not saying that British Petroleum going to US would not be able to raise capital from US oriented bank. British Petroleum is a great company to give loan to. It has a global image. It is not some Chandu Chaiwala or some Natwal Lal, which is not known to the world for good things. Natwal Lal is known to the world for bad things because Natwal Lal was the one who sold Taj Mahal to foreigners. Right? So Natwal Lal is not known for good things. Entering into a contract, being a foreigner, if I'm entering into a contract with Natwal Lal, that means I am getting fooled. So Natwal Lal sold Taj Mahal to foreigners, right? On which it doesn't have any rights. It's a sovereign asset, right? Natwar cannot sell, but he sold. And there are enough fools in the foreign land. But British Petroleum is not like Natwar. British Petroleum is a well-reputed company, wants to expand its wings from UK to US. In order to expand in US, it needs dollar. Its own currency, GBP, would not work. It would have to pay salaries to the employees of US geography in dollar, because GBP will not be a legal currency in US. So British Petroleum going to US, raising loan in US currency, in US market, will get a rate which will always be higher than IBM being a US company raising capital in US market in US currency. So if IBM can raise in US market a loan at 5%, British Petroleum would raise the same loan in US market at 6%. Here comes the concept of cross-currency swap. The treasury team of British Petroleum meets with the treasury team of IBM and enters into a contract where British Petroleum says to IBM that, hey, IBM, you raise loan in your own country, in your own currency. I will raise loan in my own country, in my own currency. Then I will transfer my currency loan to you, and you transfer the loan which you have taken in your currency to me. That way we will be better off. Hey, IBM, you will be better off by 1%. When you come and raise capital in GBP in my country, you will be charged 7%. But because I am raising that capital on your behalf, I will be charged. I will be charged on the 6%. So on that GBP loan, rather than paying 7%, you will have to pay 6% if I am raising on your behalf. At the same time, when I am raising US dollar loan in your country, I will have to pay 6%. But since you will borrow money on my behalf, you will have to pay 5%. So naturally, I am paying 5% as IBM. Sorry, as British Petroleum. Right? So both are better off by 1%. Right? By entering into a cross currency swap. The reason of cross currency swap is cost of interest or interest cost and expansion in geography. I'll take a pause of a minute over here just to understand if someone would like to ask a question on whatever I have talked about so far. And for your kind information, suddenly the number of people who have joined the class has increased after break. Suddenly, the participation has increased from some 20 odd to some 30 odd. Because most of the people know that in second half we take attendance, right? Smart. Yeah. Any question? So IBM will take loan in US currency only. British Petroleum will take loan its own home currency GBP only. But US based company IBM will pay interest on GBP loan, because that GBP loan will be transferred from BP to IBM. And British Petroleum will pay interest on US dollar loan, because that US dollar loan which IBM has taken will be transferred from IBM to British Petroleum. Right? Is it clear? So far, is it clear? Before we move forward.
Sumit, here, is there any counterparty risk? As in, I know we are talking about British Petroleum and IBM, but
counterparty risk is there, obviously.
Right.
But since, yes, counterparty risk is there.
Okay.
Yes, counterparty risk is there. In any OTC trade counterparty risk is there. Since this trade is not going to happen between a dealer, which is an investment bank, and a company, the counterparty risk goes up. That is true, which can be worked upon by bringing a tri-party contract where you put a custodian bank as a third party and do all this transaction through that third party. That can be discussed and decided between both the parties. Yeah. Any further question? Tell me. No? All right. So how much loan will IBM will borrow from US market and how much loan will British Petroleum be borrowing from UK market would depend upon their requirement, obviously. But you need to understand the risk exposure needs to be same. Right? So on the effective rate, whatever is the foreign exchange rate, that would also help them decide how much would one party would be borrowing and how much would another party be borrowing. Right? So on trade date, if FX rate is 1 GBP is equal to 1.3 US dollar, then to keep the exposure same, the loan in GBP, if it is taken for 100 million GBP, then the loan in dollar terms will be taken as $130 million. Right? That way, their exposure would remain same, right? Notional amount exposure would remain same. But unlike all other swaps, here the notional amount will actually be exchanged between both the parties. So IBM will be taking a loan to the tune of 130 million US dollar from US market and will be exchanging on the trade day with British Petroleum. So we'll deliver 130 million US dollar to British Petroleum. The notional amount is getting exchanged from IBM to British Petroleum. On the other hand, British Petroleum will take 100 million GBP loan, which equals the total risk exposure of both the parties at the notional rate and FX rate of that day. British Petroleum will borrow that much of money and will transfer that loan to IBM. So here, IBM would be able to utilize that GBP pound to expand in UK geography, and same way, British Petroleum would be able to utilize those 130 million US dollar it has received from IBM to expand its businesses US geography. So on the trade day, IBM will transfer $130 million, which it has raised at an interest rate of 5%, which if British Petroleum would have tried to raise, it would have a cost of 6%. So here, by entering into this contract with IBM, British Petroleum will actually will be required to pay only 5% per annum interest rather than 6%. Similarly, British Petroleum is raising 100 million GBP loan from the UK market at a 6% rate of interest, which if IBM would have went into UK and raised that capital, it would have required to pay 7% per annum. So it is also saving 1% interest loan. Trade date, effective date. On effective date, the notional amount needs to be transferred between both the parties. That means IBM will transfer $130 million to British Petroleum. British Petroleum will transfer 100 million GBP to IBM. On which date? On effective date. Two currencies are involved over here, GBP and US dollar. Interest rate on GBP loan is 6% per annum and interest rate on US dollar loan is 5% per annum. Who will pay the GBP?
British Petroleum will pay GBP to IBM.
Right. as an exchange of notional amount, right?
Yes.
And British Petroleum will pay US dollar to,
IBM.
sorry, IBM will pay US dollar to British
British
Petroleum.
Petroleum.
Now, on the other hand, both the companies are connected with their respective banks. Yes or no? So IBM has taken actually loan from the bank in what currency? Dollar
US dollar.
US dollar. So it will have to pay US dollar to its bank. Yes or no?
Yes.
Right? It will pay US dollar to its bank, right? Yes or no?
Yes.
So it will have to receive that US dollar from whom? For interest payment.
British Petroleum.
British Petroleum. Why? Because it is British Petroleum which is utilizing that interest with that dollar. So it is British Petroleum who would be incurring the cost of using that dollar. That is 5 percentage point. On the so while you're talking about first leg, that is the notional amount exchange. In that case, IBM will be receiving GBP and British Petroleum will be receiving US dollar. Now, in the second settlement case where a lot of interest would be settled between both the parties, in that case, IBM will actually be paying GBP oriented interest and British Petroleum will actually be paying US dollar oriented interest. Why? Because IBM has taken loan in terms of US dollar actually from bank. So it has to pay interest on US dollar to its bank. So it has to receive that interest in US dollar from whom? From British Petroleum. So British Petroleum will pay interest on US dollar. Similarly, it is British Petroleum who has taken loan in terms of GBP from its own bank. So it will have to make payment in GBP to its bank. So it will have to receive GBP oriented interest from whom? From IBM. So IBM will pay interest on GBP and British Petroleum will receive interest in terms of GBP. British Petroleum will pay interest in terms of US dollar and IBM will receive interest in terms of US dollar to pay to its respective banks. Right? Net settlement will not happen. Gross settlement will happen. Since gross settlement is going to happen and rates are fixed, every time the cash outflow is fixed for both the parties. IBM had taken a loan of 1.3 million GBP. Sorry, 100 GBP. So for IBM, the interest will be 100 into 6%. That is 6 million GBP. British Petroleum has taken a loan of 1.3 million US dollar. So it will have to pay 5% on 1.3 million dollar. That will be equal to 6.5 million dollar. And for next 5 years, the same thing will happen. If the contract life is 5 years. After this 5 years, what will happen? Third leg will also come up. In the third leg, that notional amount would be re-exchanged because IBM Bank will demand IBM to pay US dollar loan of $130 million, which IBM had taken on behalf of British Petroleum from its bank. So British Petroleum will have to pay that US dollar, 130 million US dollar back to IBM so that IBM can repay that $130 million loan to its own bank. Similarly, British Petroleum on behalf of IBM had taken a GBP loan of 100 million GBP. So that British Petroleum will further receive it back from IBM so that British Petroleum, after receiving this GBP value from IBM, can pay back to its own country's bank. So as a part of third leg, IBM will re-deliver the 100 million GBP to British Petroleum and British Petroleum will pass on that 100 million GBP to its bank. And British Petroleum will re-deliver that $130 million USD to IBM and then IBM will pass on that $130 million USD to its own bank. That is how this trade will be settled in 3 different ways. So notional amount will be exchanged to enter and at the exit also notional amount will be re-exchanged between both of them. Any question? Interest amount will be settled not on net basis but on gross basis. Any question?
So I didn't understand the last leg where again notional amount is being set.
Try to understand. IBM has taken loan. Actually, IBM has taken loan from its bank in which currency?
US dollar.
Don't you think bank will want the money back? It's a loan. It is not equity, right?
Yes.
Bank would need every loan has a tenure, right? Here the tenure is 5 years. So bank will ask IBM to repay 150 million or 130 million US dollar again. Yes or no? Pay back.
But
See, if a bank gives a loan to IBM, don't you think it will get the money back from IBM after 5 years on the maturity?
yes.
Right? For example, if you take a personal loan from any bank, Nehal, do you run away to London?
No.
Or do you repay your loan back to the bank?
Repay the
Huh?
loan.
Similarly, don't you think IBM has taken $130 million of loan from its country's bank? Don't you think IBM is responsible to pay back that money to its bank?
Yes.
But it has that money? Does it have the money? $130 million. It has actually given to whom?
British Petroleum.
So now it will ask British Petroleum to give the $130 million back to him, right?
Yes, yes.
So that it can clear off its liabilities.
Yes.
Similarly, British Petroleum will say, I also have to pay back my liabilities of 100 GBP million to my country's bank. So give that money back to me.
Okay.
That's the third leg where the re-exchange of notional values will happen.
Thank you so much.
Any question on this? Any question, guys? Come on. If not, then let me take the attendance. Priyanka Marathu, are you there? Priyanka? I had seen one Priyanka, but I don't know if it was this Priyanka only. Praveen Kumar? Praveen Kumar? Strange. Kamesh is there. Santosh Kilari? Santosh Kilari? Shramani CH. Aditya Podar. Aditya Podar. Shashank had said that he would not be able to join, right? But since he has said that, doesn't mean that he will get attendance, right? He has not joined, means he has not joined. Anand Kishore.
Anand also had message that he had to go to office.
Okay.
And Sudhvi is absent because of personal reasons. So.
Okay. Richa Singh.
Yes, Sumit.
Sujata Kumari. Ratnesh Srivastava. Yash Ajay Pratap Singh. Prasad. Pratik.
Present, sir.
Chandrasekhar Swayan. Samvid Gupta. Dhruv Sardana. Thanga Shruti S.
Yeah, hi Sumit, hi.
Hi. Yeah. Kiran Biradar.
Present.
Sai Giritar V. Sai Giritar V. Rahul Pathak.
Parents, sir.
He was there.
Sumit,
Present.
this is
Abhinav
Santosh.
Kumar. Santosh. Okay.
Sorry, I'm in office.
Sumit,
In a
I'm
meeting.
It's okay. It's okay. I will pass. Santosh, I'm marking attendance. There was some lady who's saying sorry something. Who was it?
Sumit, I'm
Abhinav.
present.
Sorry, what's your name? Sorry,
Ashita.
I can't see your name.
Ashita, like 38. Roll number.
30. 30.
Great.
Arey Harshita yaar, I have already marked your present. Don't worry. If I'm not taking your name, then you do not have to say I'm present. Simple as that, right? I already marked, see, Harshita Goga. We just confused. I was listening Ashita. I thought there is no Ashita. Suddenly the new person is. Saurabh Dubey.
Yes, Sumit.
ये कहाँ है आज? Sai Girithar is not present. Sai Girithar? Strange.
I get it there actually. But now I don't
है
know.
ना बाबा?
Yeah,
Network
he
issue.
joined.
है ना, मैंने भी देखा. बेनिफिट ऑफ डाउट ले लेता है हमेशा. फिर बोलता है अटेंडेंस नहीं है. कहाँ है ढूंढो. Yeah. I had seen him, so I'm marking him present.
Hello.
Yeah.
Vijay Kumar sir.
विजय कुमार आपका नाम आएगा. सबका नाम. श्रेयस श्रीवास्तव. श्रेयस श्रीवास्तव. शहनाज. ऋतिक कुमार. अंकित सरकार. स्मृति सेठ. मयंक शर्मा. समीर चक्रकर. समीर चंद्रकर. सॉरी, समीर चंद्रकर. समीर चंद्रकर. ऋत्विका was there. प्रियंका खामकर. Priyanka Khamkar. I guess I saw this Priyanka earlier. See, Praveen Kumar is there. Praveen Kumar is there. Let me mark him present. Maybe he's in office and that is why he's not able to speak.
Yeah, Praveen and Abanita both are in office and can't speak.
And Sai Girithar is there. We were correct, right? Sai Girithar is there.
Yeah.
ठीक है. Tanga Shruti is there. Ritvika is there. Satyaki is there. Chile. Priyanka ko I had seen, but since she's not there, that I don't want to give. Nivedita is there, and she is now well. Next is Nabhanita. You think she's in office. Amrit Gupta. Amrit Gupta. Amrit Gupta. Okay. Shirish Nair had sent me an email. Since it's working, he would not be able to join. That is fine. Yeah. Did I miss anyone's attendance? Anybody feel that I missed his or her attendance?
Sujata has messaged in the chat group, Zoom chat. She's also in office.
Sujata, right? Monica, I have marked your present. Don't worry. Sujata Kumari, I have marked present already.
Okay.
Anyone else who thinks that I missed his or name? Prasad is missed today. Prasad has not. ठीक है.
Sumit ji, on 9th I was present, but during attendance I went for Ganesh ji's Aarti.
Oh, how sweet. So Ganesh ji asks you every time to do Aarti? Every day do you do Aarti of Ganesh ji?
No, Ganesh Chaturthi was there, na Sumit? Not every day.
So Ganesh Chaturthi was on 1st, right? सब क्या नाम है आपका? किरण,
Kiran
right?
Biradar, Sumit.
किरण 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 मेरे भाई, let me search you. Yes, over here you are there. 9 तारीख कब है की है? 28 है. क्या this date, right?
Yes, sir. Yes, yes.
ठीक है, I marked your.
Thank you.
Yeah.
Sumit, Shrey messaged me. He's also in a bank.
But then he's not present in the class, right?
Yes.
Shrey. Who said Shrey Srivastava? Okay.
Yes, yes, yes.
Shrey messaged. But Shrey messaged you, but is Shrey in the class?
Okay.
Like, see, there are many people who would be in office, that's fine. But even if they are logged in through office, that is important. So I can't see Shrey's name.
Good evening, sir. Shrey this side.
Is there? Okay, let me mark his.
So I'm in office.
Okay, Shrey, I'm at my home.
Thank you, sir.
Thank you. ठीक है, चलिए. How's everything, Chandan भाई? सब कैसा चल रहा है?
बढ़िया सर.
क्या चल रहा है? जोधपुर में मजे ले रहे हो आप?
जी सर.
जोधपुर में खाने का बहुत आराम है. नहीं, भाटी चाय वाले का चाय पीते हो?
बिल्कुल सर, नजदीक ही है.
और प्याज की कचौरी कहाँ से खाते हो?
मिर्ची बड़े.
मिर्ची बड़ा
मिर्ची बड़े खाते हो क्या? प्याज की कचौरी नहीं खाते हो क्या? जनता
बिल्कुल
स्वीट
खाते
होम.
हैं. बिल्कुल जनता स्वीट होम.
और वो गुलाब जामुन कहाँ का फेमस है?
गुलाब जामुन सिटी के अंदर का है, नाम याद नहीं आ रहा.
और समोसा कहाँ का फेमस है?
शाही समोसा. आइए सर, नजदीक ही है.
हाँ, मैं जाता रहता हूँ यार. मैं यहाँ से कुछ अभी एक नया रोड बना है, तो वहां से इट टेक्स ओनली 1 hour and 20 minutes ऐसा कुछ लगता है. जाता रहता हूँ. तो so those anyone in the session who is like kind of a foodie, a vegetarian food bliss, if you want, Jodhpur is the place. You know, if you want good food, and if you like sweets a lot, the traditional sweets, yes, if you like it a lot, Jodhpur is the place, and it is not very far from your location, Ahmedabad. From Maninagar, there are multiple buses which goes to Jodhpur every night. There would be more than 12 buses which would be going, AC class, good class buses which would be going to. And there is this Suryanagri train which goes to Jodhpur from Ahmedabad every night, 9 o'clock. Without a ticket, you can go and sit in the train. There is no problem. You can manage it. Go and have food in Jodhpur and come back to Ahmedabad. Right? Enjoy, food is life. You should love food. Right? So come to Jodhpur, guys. Me and Chandan both belong to Jodhpur. I belong to Jodhpur division. He is in Jodhpur itself. Right? So guys, please come enjoy. And then there are Rahul यहाँ पर Raja अभी भी है, Raja Gaj Singh.
Gaj Singh.
Is Gaj Singh, and you will find a lot of royalties in Jodhpur. मजा आएगा. Right? Though his all places are very expensive to really go and eat something, but you can always go and visit it as like a museum. Right? So और इसमें जोधपुर ट्रेडिशन के ऊपर एक सीरीज बनी है which is there on बंदित something करके है. It's a music competition of traditional music. It is there on Amazon Prime. इसका नाम मेरे दिमाग में आ नहीं रहा है, but it's a very good series. Do watch it. A lot of Jodhpur royalty will reflect in that. और भाटी चाय वाले को भी दिखाते हैं उसके अंदर. भाटी चाय वाला is a very famous tea वाला.
Bandish Bandit.
हाँ, बैंडिश. वही मैं एक्चुअली मैं आई जस्ट ओपन दिस Amazon Prime on. वो देख रहा था कि इसका नाम, हाँ आपने बता दिया. So it's a very good series. Watch it. You will find लोगों को मिर्ची बड़ा खाते हुए देखेंगे आप उसमें. So you will feel like having all this. चलिए. So a detour from our regular course, but let's go back to our regular course. Now, what we have understood as part of cross-currency swap, there is one more version of cross-currency swap, which is an advance to what we understood so far. The only advance is factor in that is capturing the change in foreign exchange rate between multiple settlement dates during the life of the swap. In this, if you have noted, we have only looked at FX rate once. That is, at the date when we were entering into the contract, we looked at that FX rate. Our liabilities remained same with respect to interest payment and with respect to resettlement of the notional amount as a third leg, end of the contract. So, for example, if IBM has given $130 million to British Petroleum, then British Petroleum has returned the same value back to IBM at the end of the swap. But is it possible that at the time of entering of the contract, if 1 GPP was equal to $1.3 US, then at the time of exiting the contract, that is after the end of 5 years, the FX rate will remain same?
Not necessarily.
99.9% it is not possible, right?
Yeah.
Right. So another variation to it is a cross-currency swap only, but it's better known as cross-currency resettable swap, where the liabilities will keep getting resettled every settlement date. And there are many multiple settlement dates, right? In this solution itself, we have 5 settlement dates with respect to interest settlement, right? So resettable swap. So let's see what is the difference between the resettable swap with the normal swap. So with respect to normal swap, I have already explained you everything. Now with respect to resettable swap, what will happen is at every settlement date on which interests are exchanged, on that day, the currency will be relooked. The FX rate between US dollar to GBP will be relooked and exposure will be resettled. So for example, to begin with, on day 1, our 1 GBP was equal to how much? 1.3 US. So as with this, at the start itself, the notional amount was transferred from one party to another party and another party to first party, right?
Yes.
That was transferred with respect to 100 million GBP and 130 million USD, right?
Right.
Now, at the second settlement date, when the second interest is getting settled, so the first interest liability will be calculated on the same notional amount. At this notional amount at which we started the contract, at that notional amount only, the interest liability will be calculated and paid on the first interest settlement date, right? Which would be 6 months from the effective, or 1 year from the effective date, because interest payment is annually in this case, right? Now on this date, when interest is going to be paid, for the first time, that is 1 year from the effective date, again the GBP and USD rate will be looked. And that time, for example, if GBP and USD rate is 1 GBP is equal to 1.35 USD, that means for 100 million GBP, the exposure of US dollar should be how much? 135 million USD, right? So far, what notional amount has been transferred? 100 million GBP for 130 million USD, right? But now 100 million GBP is actually equal to how much USD dollar? 135 million USD dollar. So British Petroleum will say, boss, I have given you 100 million GBP, but you need to understand, you have given me only 130 million USD. But at today's rate, it is actually worth 135 million USD. So at the end of 1 year from the effective date, IBM will have to transfer balance 5 million USD to keep the same exposure equal to that day's currency or the latest currency rate. So the notional amount is rechanged from 100 million GBP to 130 million USD to 100 million GBP and 135 million USD. So the interest liability will also get accrue on 135 million USD. The GBP interest liability will remain on 100 million GBP. Why? The exposure of GBP is still same. So on GBP, the interest calculation for the second interest payment date would happen on 100 million GBP only. But for second interest settlement date, the USD interest will be calculated on 130 million USD, not on 130 million USD. Right? Right? Why? Because at the end of year 1, when the first interest was paid, at that point in time, the currency rate was looked upon, and as per the latest currency rate, the exposure had changed from 130 to 135 million USD at the end of year 1. So now at the end of year 2, the interest will get due on $130 million or $135 million.
135.
Right? So the interest charge is on $135 million, not on $130 million. Now on that date, when the second interest is paid, on the same day, the currency rate will be relooked. And now, for example, the currency rate is 1 GBP is equal to 1.5 USD. That means 100 GBP is equal to 150 USD. A call will further go from British Petroleum to IBM that, boss, I have given you 100 million GBP, but that same GBP is now worth $150 million. So please transfer. You have only paid me $135 million. So you need to transfer those balance $15 million to me to keep the exposure same at the latest currency rate. So at the end of year 2, or at the beginning of year 3, or at the end of the year 2, when this interest is settled, at the same time, $15 million further will be transferred from IBM to British Petroleum to keep the exposure as per the latest rate. So now for the third year, or at the end of year 3, the interest will be calculated not on $135 million, but on $150 million. Whereas the GBP exposure remains the same. So the GBP interest will remain 6 million GBP, but on USD, the interest rate of 5% will be charged on $150 million. So the interest amount will change from 6.75 to 7.5 at the end of year 3. The same day when this interest rate is getting settled, on that same day, the GBP to INR rate will be USD rate will be further relooked. And for example, that rate at the end of year 3 is, for example, 1.4 USD to 1 GBP. Then a call will go from IBM to British Petroleum that, hey, British Petroleum, you have given me 100 million USD, but I have given you, you have given me 100 million GBP, but I have given you 150 USD. But the rate, as per the current rate, the exposure to you should be equal to 140 million USD only. So you need to transfer back 10 million US dollar to me. So British Petroleum will transfer $10 million USD to IBM and will bring the exposure to 100 million GBP equal to 140 US dollar. So at the end of year 4, so this is happening at the end of year 3. This transfer is happening at the end of the year 3 with the settlement of third year's interest. Now for the end of year 4, the interest will be calculated on this. So again, the GBP interest is same, but the interest on dollar is calculated on $140 million. That is end of year 4. Now on the end of year 4, again, the GBP to USD rate will be relooked. And for example, if that is 1.2, then again British Petroleum will have to transfer the balance 20 extra because it is holding $140 million. Whereas as per the rate, it should be holding only $120 million. So it will transfer the $20 million back to IBM. And at the end, as this is happening at the end of the 4th year, right, or the beginning of the 5th year, at the end of the 5th year, the interest which will be settled will be based on this exposure. And at the end of the 5th year, because that is the end of the swap life also, so the entire $120 million will be paid from British Petroleum to IBM, and entire 100 GBP will be paid from IBM to British Petroleum as the third leg. IBM will deliver 100 million GBP to the British Petroleum, and British Petroleum will deliver 120 million USD, and it will be the end of the swap life. So here you would be seeing that the exposure remain equal. No doubt, daily basis it is not happening, though currency rate changes every second, but it is impossible to do this kind of transfer. They are business people, they have to focus on the business. So they are resetting the value of their exposure every year when they're settling the interest. When they are paying interest for the first year, they are settling the exposure for the calculation of interest for the next year. And that they will keep doing till the time they reach the end. Is it clear? That is the only difference between a normal and a resettable. That in resettable, the exposure, the notional amount exposure will keep on changing every year on each settlement date of interest. And accordingly, along with interest, one of the party will have to either pay dollar or either receive dollar in order to keep the exposure same. Right? Is it clear? So the interest payment in case of resettable will be different. The interest settlement amount will be different than these one. Right? In case of resettable, the GBP interest will remain same.
US dollar will change.
The US dollar interest will change. For the first, it will remain same because the first year interest will be charged on the very first time when you paid the notional amount. Second May it will change to 6.75, 7.5, 7, and then 6. This would be the payout as compared to this one. So see, if you compare this one with this one, you'll find their numbers are different, especially here, here, and here, and also here. Right? Is it clear?
Yes, sir.
Okay. Now we are left with the last but not the least, that is credit default swap. Now, credit default swap, guys, are performed in order to reduce the credit risk. If you have an exposure to any loan and you want to reduce the counterparty risk, you can buy credit default swap. Which kind of companies have credit exposure? Banking companies, the companies which give loans, or the investors who have invested into bonds. Those who have invested into bonds, they are sitting on a risk. What if they do not receive their money back which they have invested in bond? What if the company which had issued bond defaults, goes for bankruptcy? then the investor would not receive their money back. Or those who invest into money market instruments. Generally, money market instruments would be risk-free, but still, there are certain money market instruments where there's still a risk exposure. For example, commercial paper. Commercial paper are issued by corporates to meet their short-term working capital liabilities. And a corporate can default. Yes, a corporate can default. There's a very high chance that a corporate defaults as compared to government. So any investor who has invested into loan, bonds, money market instruments, similarly, banking companies invest into loans, bonds, money market instruments, institutional investors into bonds and money market investments. Corporates have receivables. So all of these parties, be it banking company or institutional investor or corporate, they suffer from something called as credit risk, default risk, or counterparty risk. Any kind of credit event can occur which will result into non-receipt of what they actually invested. What can be a credit event? Failure to non-payment of interest or principal on due dates. A company borrowed money and now it is not able to repay the interest or repay the principal amount back. It's a credit event. Issuer or borrower has filed for bankruptcy. Any issuer of money market instruments or bonds has filed for bankruptcy. Basically, it has no money to pay the money, the bondholders the money back, right? Or the money market investors the money back, right? Similarly, a credit event can also be an event where a credit rating company reduces or downgrades the credit rating of the company. That is also a credit event. And fourth is any debt restructuring exercise initiated by the company. Debt restructuring means asking the bank to reduce the coupon rate or interest rate because the company might not be in the position to earn enough to pay the existing interest rate. Or asking the bank or the investors to increase the repayment schedule. To start with, if they have entered into a contract where they would repay the money on bond or loan in 5 years, now they are asking to repay in 6 years or 7 years or 8 years or 10 years. That means the company's earning capacity has gone down. What it thought it would earn in 5 years, now it's going to earn in 7 years. That is why it is expecting or it is asking for an increase in repayment schedule. Or any request of the company to convert its debt into equity. That's a very problematic thing, right? You lend money to someone and that person says that I had issued bonds, but let's convert that bond into equity. That means the company will not have to pay the money back ever to you, right? So these are various credit events: failure on to repay the interest or principal, credit rating downgrade of the corporate which had issued bonds or money market instruments or had taken loan from banks, borrowers filing for bankruptcy or issuer of bonds filing for bankruptcy. That means they do not have any cash or money to repay their liabilities. And fourth, companies asking for any kind of debt restructuring. Debt restructuring can be any of these three events. When companies ask for lower interest rate as compared to decided interest rate, or when companies ask for making the repayment in a longer duration as compared to the scheduled or earlier planned as per the contract schedule, or asking by the corporate to convert debt into equity, or asking by the borrower to convert the debt into equity. The borrower is asking the investor to convert the debt into equity. So these are some of the credit events which basically reflect the credit risk. Let me just close my room's door because a lot of insects are coming inside. Just give me All right, guys. So credit default swap. How can you reduce this credit risk, or how can you reduce the any negative impact of any credit event from your borrower? By entering or buying a credit default swap from any dealer who is ready to sell it. Again, investment banks playing the role of dealer create such kind of credit default swap and charge premium for that. Let's look at an example. Fidelity Investment has invested into Tesla Inc. secured bond with a BBB+ rating, having a bond term of 5 years, has invested $400 million in Tesla bonds. Fidelity Investment is an investor, right? Ayushi, Fidelity Investment is an investor. It has invested before entering into any of this. Don't look at any of these. Just look at this. Fidelity Investment had $400 million. It has invested into what? It has invested into secured bond issued by Tesla Inc. with a credit rating of BBB+ having a bond term of 5 years. So here, reference entity is Tesla Inc. Reference obligation is secured bond with BBB+ rating. Tesla Inc. will be considered as what? Reference entity, and reference obligation is what? Secured bond. Now, Fidelity Investment has invested $400 million in Tesla bonds, but now it is afraid. What if Tesla files for any credit event? What if Tesla files for bankruptcy? What if Tesla fails to repay me back? Fidelity Investment is sitting on risk or exposure or not? Tell me.
Yes, sir.
Right? It is sitting on a risk exposure of how much? $400 million. How much?
$400 million. $400 million.
In order to risk, it wants to hedge its risk. In order to reduce its risk, counterparty default risk, it can enter into a contract by purchasing a credit default swap from any investment bank if any investment bank is ready to offer such credit defaults. For example, here in this case, Goldman Sachs is ready to offer a credit protection by selling a credit default swap. Right? So how this trade will happen? Fidelity Investment and Goldman Sachs are entering into a trade, for example, on a trade date of 30th December 2020 and the effective date of 1/1/2021. Who is the credit protection buyer? Fidelity Investment. Who is the credit protection seller? Goldman Sachs. What is the reference entity on which Goldman Sachs has taken guarantee? Tesla. What is the reference obligation on which Goldman Sachs has given credit protection? Secured bond of Tesla with BBB+ rating. What is the notional amount? Now that depends on Fidelity. If Fidelity wants to go for full hedging or partial hedging. If it wants to go for full hedging, it will go with a notional amount exposure of how much? $400 million. If it wants to go for partial hedging, it will go for any other amount which is lower than 400 million. For example, in our case, we are believing that Fidelity is going for partial hedging with $200 million. Okay. The term of CDS, again, you want full hedging or partial hedging? If Fidelity wants full hedging, it will go with the same term as per the bond term, that is 5 years. If it wants partial hedging, it can go for any term lower than the bond term, right? Right now, for example, in this case, we are assuming that it is entering into a contract to cover a term with respect to full hedging, that is full 5 years of term. Credit events. What can be the credit events? I have already explained all the credit events, right? Any of these credit events happen, what will happen? Goldman Sachs will have to give $200 million to whom? Fidelity. Yes or no? At the occurrence of any of this credit event, basically credit default is visible, and that is why Goldman Sachs will have to promise to pay as per the promise. But will Goldman Sachs do it for free? Will Goldman Sachs offer such kind of insurance or credit default swap for free? It will charge a credit default swap premium. It will charge what? A CDS premium. So for example, that is 2% per annum payable quarterly. 2% per annum payable quarterly. Who will pay to whom? Fidelity Investment will pay to whom? Goldman Sachs. 2% per annum payable quarterly. That means what? 2% divided by 4 multiplied by $200 million every quarter needs to be paid by whom? By Fidelity Investment to Goldman Sachs. Till when? Till the end of the contract. And when will the contract end? The contract will end either in the 5 years or before, if any credit event happens. So either if there is no credit event which happens, then the tenure will remain 5 years. For the next 5 years, every quarter, Fidelity will have to keep paying premium to Goldman Sachs. But if credit default happens before that, then the contract will cease to exist. Goldman Sachs will give $200 million to Fidelity. Right? Is it clear? And Fidelity will stop paying any premium because the contract is over. So for example, in this case, this is the table I have built. For 5 years, every quarter, what will happen? Every quarter, Fidelity will pay how much money? 2% divided by 4 into $200 million. That is $1 million. $1 million. Every quarter, it will keep paying. For how many quarters? If there is no credit event happen, if there is no credit event is triggered, then for the next 5 years, it will keep paying. So total, how much it will have to pay? Total, it will have to pay $20 million to Goldman Sachs to have this facility. So Goldman Sachs total earning will be equal to $20 million. In what case? If there is no credit event which is triggered. In case, if on 31st August 2022, a credit event is triggered, that is, for example, one of the credit events, for example, Tesla has filed for bankruptcy due to business failure. So 31st August 2022 will fall in which quarter? Will fall in 8th quarter. 8th quarter. Basically, you started on 1st January 2021. The first quarter ended on 30. First quarter ended on, and you have to make the so first quarter will so basically you have to make the payment upfront. If I forgot to read this slide, premium payment is upfront.
So
not at the end of the quarter, but the before the
start of the quarter. Okay.
Start of the quarter.
Okay.
Right. So first payment will be made on 31st December itself when you are entering into the contract.
Okay.
Right. So like this, second quarter will be March quarter, third quarter will be June quarter, fourth quarter will be September quarter. Again, December quarter will become 5th quarter, 6th quarter will become March quarter, 7th quarter will become June quarter. This happened on August. So your 8th was still due because your 8th premium was due on 30th September. Before that, this event has happened. So now you do not have to pay any more premium as Fidelity Investment. That is one thing. Second, it is the responsibility of Fidelity to notify Goldman Sachs about credit event. If Fidelity forget to notify this, then Goldman Sachs liability is 0. So Fidelity will have to notify to Goldman Sachs that boss, credit event has triggered. The company Tesla, the reference entity Tesla has filed for bankruptcy. So the reference obligation of BBB plus secured bond is under risk now. It will have to tell the same to or notify the same to Goldman Sachs. Now, Goldman Sachs, after getting this notification, can settle this contract in two ways: physical or cash. Look at it in both of the ways how it will be done. If it is a physical settlement, then it's very simple. Goldman Sachs will ask Fidelity to give that 200 million worth of bonds to Goldman Sachs, because Fidelity has taken exposure. Though Fidelity is holding bonds worth of how much? 400 million. But it has taken exposure of credit default swap of how much?
200 million.
200 million. So Goldman Sachs will say, hey, Fidelity, transfer half of your Tesla bonds at your purchase price. The current price, market price can be zero, doesn't matter. But at your purchase price, you had bought 400 worth of Tesla bond and took an exposure of $200 million. So give me $200 million worth of your Tesla bond. That is half of your Tesla bond, physical bonds to me, and I will give you $200 million. Right? That is what physical settlement. Easy. Transfer the securities, get your money at your purchase price, not at your current market price. Current market price of these bonds can be anything, doesn't matter. Right? If it is cash settled, then the market valuation of these bonds needs to be performed. For example, after this credit event, the market value of this 400 million bond has been reduced to $150 million. How much?
150.
$150 million. That means if today Fidelity goes to market to sell these bonds, Fidelity will still receive how much? 150 million. So if $400 million worth of bonds market value has been reduced to $150 million, then what would be the $200 million worth of bonds market value be? $75 million, right? So what is the actual loss for for Fidelity? The actual loss for Fidelity on an exposure of 200 million is equal to how much? Only $125 million. Why? Because those physical bonds, Fidelity can go and sell in the market for $75 million, right? It will incur loss of how much? $125 million, right? That loss will be covered by Goldman Sachs in cash settlement. So Goldman Sachs will say, you keep the securities with yourself. The worth of that security is $75 million. But since you had taken a risk exposure to $200 million, so I will pay you your loss. Your loss is how much? 125 million. Because those securities are not worth zero. Those securities are still worth $75 million, right? So your loss is $125 million at current market valuation. Take your $125 million. Do not give your securities back to me. I don't need your securities. You keep your securities, sell in the market. You will get $75 million, right? So if you want 200 full, then give me the securities, take 200. If you don't want to give the securities, then take $125 million and keep your securities with yourself. So either it can be physical settlement or cash settlement. Is it clear?
Yes.
Any question, guys? Anyone? Any question, guys? Anyone? Let's look at one more example. Maybe things will become even more clear.
Sumit, who has the right to decide the type of settlement, whether it be Fidelity or
both the parties?
Goldman
Again,
Sachs?
this is OTC market, right? So both the parties would have the right to decide which would they want to go for.
Okay.
But whatever they decide, that has to be decided at the time of entering into the contract. In the middle of the contract, they cannot say, no, SNE वैसे कर दो, SNE वैसे. Right? Whatever is decided at the time of the entering into contract, that will be performed at the time of settlement. Right? Okay. So here in this case, if you look at it, Fidelity has been playing the role of what? Hedging. Fidelity had a risk exposure of 400. It has done partial hedging by entering into a contract which covered its risk up to $200 million. So the net loss of Fidelity at the time of event trigger, the net loss of Fidelity is actually only $200 million because it has got securities of, in fact, the net loss for Fidelity is actually, the recovery rate is $150 million, right? For $400 million, the recovery rate is $150 million. And it will receive $125 million from
Goldman Sachs.
Goldman Sachs. So the net loss is actually how much? $125 million. The balance 125. The total exposure was $400 million. It has $150 million worth of securities, right? It will receive 125. It has $150 million worth of securities. It will receive 125 million from
Goldman Sachs.
whom?
Goldman.
Whom?
Goldman
Sachs.
Sachs.
Goldman Sachs. So net loss will be equal to 400 was the total investment minus 275 it will receive. Net loss will be equal to how much? 125 million. Right? If it would have gone for full exposure, the net loss would have been actually zero. Because if you would have gone for full exposure, it would have received 250 from Goldman Sachs. 150 was the worth of the securities in case of cash settlement, right? And 250 it would have received from Goldman Sachs. So it would have received 400. Basically, it's 400 worth of securities would have remained 400, right? For itself. Now let's look at from a different perspective, but another example. Over here, for example, Yash is a speculator. Yash is what? Speculator. Yash has a view on a reference entity Kingfisher Airlines and a reference obligation unsecured bonds, which Kingfisher Airlines had issued with a tenure of 5 years to the tune of 1,000 crore. Is Yash investor into these bonds? No. Yash is not an investor into the bond. But Yash has the knowledge that Kingfisher has issued unsecured bonds of the tenure of 5 years with the exposure of 1,000 crore. Right? Yash is not an investor into it, but Yash has a bearish view on Kingfisher. Yash has a bearish view of Kingfisher. Yash thinks that the credit rating of Kingfisher is going to go down, or maybe so any of the credit event can happen in case of Kingfisher. Any of the credit event, right? So, in order to get advantage of this situation, what does Yash go? Yash, being a bearish view, having a bearish view, buy a credit default swap on this reference entity, Kingfisher, and on this reference obligation, unsecured bonds, but of what notional amount? That is what Yash has to decide. It can be anything between up to 1,000 crore, right? For example, Yash has taken it for what notional amount? 100 crore. So it will get a quote from JPMC, bid and ask. So the premium, the quote is in terms of premium. The premium will JPMC will pay or Yash will pay? Yash will pay, right?
Yes.
Yes, sir. So if Yash has to pay the premium and JPMC is receiving the premium, will it be 3.65 or will it be with 4%? While receiving JPMC will always receive higher, while paying JPMC will always pay lower, right? Right? So if JPMC is on the receiving end, JPMC will go for 4% premium, right? Yes or no? So Yash is a buyer of this and JPMC is a seller of this. So JPMC's sell rate is 4%. JPMC's buy rate is 3.65. I told you bid and ask rate is from the context of investment banker. Investment banker is going to buy at 3.65, sell at 4%. If Yash has to buy, then it will have to look at which rate? Sell rate. Sell rate, right? So the sell rate of this policy is 4%. So Yash will have to pay 4% payable quarterly. Upfront payment of premium. Right? Do Yash need to take it for 5 years? No. It is Yash's choice. For example, Yash has chosen the term for how many years? Only 1 year. So within 1 year, if any credit event happen, Yash will get a money from JPMC. And within that 1 year, if no credit event happen, the loss for Yash will be equal to what? 4 quarters of premium. That's all. 4 quarters. Yes, do not have to pay more premium for the entire 5 years. No. It has nothing to do with the tenure of the bonds. It has to pay premium only for what tenure it has taken the CDS. Right? It has taken the CDS for only 1 year. It will pay premium only for 1 year. Every quarter. Now, what would be the premium paid by Yash? 4% divided by 4 into 100 crore, which will be equal to nothing but 1 crore. Right? If no credit default happened in the entire 4 quarters or the entire 1 year, then the loss for Yash is 4 crore. The profit for JPMC is 4 crore. But if credit default happened, for example, credit default happened on 4th April. So what would be the triggered quarter? 3rd quarter. Why? Because upfront payment. 31st December, first payment will be made. 31st March, second payment will be made. Now, third payment was to be made on 30th June. But before that, 4th April itself, the event has happened. What is the event happened? What is the event happened? Kingfisher filed for bankruptcy. Kingfisher filed for bankruptcy. Anything, right? Any of these events which has happened. What will happen now? Not
TPMC, no. Yash has to notify.
Yash has to notify. Yash has to notify or inform to the JPMC or CDS seller that this credit event has happened. So what JPMC will do? JPMC will find out the market value of that bond after the credit event. So what was the bond issued by the company? 1,000 crore. What is the market value? For example, the market value of 1,000 crore bond is now 250 crore. What is the risk exposure Yash has taken of 100 crore? So if 1,000 crore is worth 250 crore, so what would be 100 crore be worth? 25 crore, right? So if this with this credit event, the loss on notional amount of 100 crore is equal to how much? 75 crore. Why? Because that 100 crore rupees is worth 25 crore at the market value. So loss is how much? 75 crore, right? So, and this kind of settlement, Yash would always enter into a cash settlement, never physical. Why? Because Yash is not holding any of the bonds. So it cannot deliver the bonds physically, right? So it will enter into a cash settlement contract only. So how much cash will it receive at the kind of credit event from JPMC? It will receive the cash up to the loss value. The loss value is how much? 75 crore. So it will receive 75 crore at the time of credit default from JPMC. What is the net profit for Yash? The net profit for Yash is 73 crore. Why? Because it had paid two quarters premium, that is 2 crore, and it has received 75 crore. Net loss for JPMC will be 73 crore. It received 2 quarters premium, but it had to pay 75 crore. Right? Any question?
Sumit,
yeah.
In the, if you scroll up this, you have written RE and RO.
This reference entity and reference obligation.
Oh, okay.
Reference entity on which JPMC is taking credit exposure or giving credit default guarantee, and reference of entity and reference obligation is a bond.
Okay.
Or the security. Is it clear? Similarly, here, if, for example, yes, rather than having a bearish view on Kingfisher Airlines, it had a bullish view. That means Kingfisher is not going to file for any. That means Kingfisher is not going to see any credit event in the next 1 year. That's what Yash thinks. Then Yash will become a buyer of a credit default swap or seller of credit default swap?
Seller.
Seller of credit default swap. Then in that case, Yash will receive what? Premium. At what rate?
4%. No, 3.65.
3.65% per annum to be paid quarterly by JPMC. JPMC will pay premium this 2 years, right? Any question, guys? Anyone tell me? Any question? Right. So that is what credit default swap is. Credit default swap helps to reduce third-party risk. Investors can get into credit default swap by entering into a contract with credit default seller. Credit default swap seller generally are investment bankers. Okay. Now, rather than having one exposure to one securities, it is more believable that companies like Fidelity Investment will not only be investing into one security, they would be investing into basket of securities. They would not be investing into one share of one company share. They would be having a portfolio of shares, right? So from that perspective also, if Fidelity Investment wants, for example, Fidelity Investment has a portfolio of these 8 stocks with these investment value. That means in Fidelity Investments portfolio, there are stocks like GM Motor, GE Electric, IBM, Nike, Coke, Microsoft, Facebook, and Tesla. It is already having a risk exposure and it wants to hedge its risk. How it can reduce the risk? Rather than buying individual credit default swap on each of this exposure, it can buy a basket CDS from JPMC. So basically, it can ask JPMC to create a basket credit default swap and quote me one rate for the entire exposure. And if that one rate comes out to be lower than individual rate, then Fidelity will choose to go for basket CDS. For example, what is the total portfolio value? What is the total portfolio value? 1,250 crore, right? For each of its exposure, for example, JPMC quote these premiums. So what is the premium value? 24 point. A lot of small insects have come to my room because I kept my room door open. Now they are troubling me. Sorry. So there's a garden near to my house, my own garden. So it's a small garden, so it's very green. So a lot of insects come during the rainy season. And I'll just come to my room now. It's troubling me left, right, everywhere. But what I'm trying to say is, if, for example, Fidelity wants to take credit default swap on each of these exposure independently, then, for example, these are the respective quotes which JPMC is charging. That total cost comes out to be $24.125 million, right? Whereas if JPMC say that rather than buying individual exposure, if you buy a basket CDS on the entire exposure of $125 million, I will charge you 1.5% credit default premium. That comes out to be how much? That comes out to be only 18.75. That comes out to be how much? 18.75. Then Fidelity will choose independent individual credit default swap or basket credit default swap. Basket credit default swap, because the cost is, it is cheaper to hold basket credit default swap, right? So that is something as an extra concept. So that is how there are credit default swap can be basket also, wherein you are given an exposure to cover on a portfolio of securities rather than a single security, right? Is it clear? Is it clear?
Yes, Sumit.
And that ends the time for the day, and that also ends the topic for the day, that is swap. That completes our topic. Right on time, 8 o'clock exact. Yeah. Tell me if there are any questions. Otherwise, we will call off the session. I'm really getting disturbed by these small insects. They are attacking me right, left, top, bottom, everywhere.
No questions, Sumit.
If there are any questions, I would love to answer even in this extreme situation. But if there are no questions, then we will call off the session.
Okay.
Yeah.
Thank you, Sumit.
Nehal has no question. Thank you, Nehal. What about others? Anyone else has any question, guys?
No, no.
Anyone? Come on. No? No one? All right. Then let's call the session, guys. I would be a little quick today for leaving the meeting because it is really troublesome to sit in my room right now. Again, I'm asking any question, I would be happy to answer. All right. All right, guys. Then thanks a lot. I'm ending the meeting for all. See you whenever we
Thank
meet
you.
next. Okay.
Bye-bye.
Thank you. Bye. Bye.
Bye, Sumit.
Thank you,
Bye.
sir.
Thank you.
Thank you, Sumit.
Thank you. Bye. Thank you. Bye.